If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the book. Chapter 1: The Smart Money Mindset. Part 1: Investor versus Speculator, Know Your Role. Understanding the difference between investing and speculation determines whether you build lasting wealth or chase fleeting profits. This distinction shapes every financial decision you make, from choosing assets to setting timelines. Smart investors focus on company fundamentals and long-term value, while speculators bet on price movements and market trends. Learning to identify which role you're playing protects your wealth and guides you towards sustainable financial growth. This knowledge becomes your shield against costly mistakes and your roadmap to consistent returns. The line between investing and speculation often blurs in practice, but the differences run deeper than most people realize. An investor purchases a piece of a business with the intention of sharing in its long-term profits. A speculator buys an asset hoping someone else will pay more for it tomorrow. This fundamental distinction determines not just your approach, but your ultimate success. Consider two people who bought Amazon stock in 2010. Sarah researched the company's expanding market share, growing revenue streams, and management quality. She planned to hold for at least 10 years, viewing temporary price drops as opportunities to buy more. Mark bought because he heard Amazon was hot and expected quick gains. When the stock dropped 30% in 2011, Sarah added to her position while Mark sold at a loss, fearing further decline. The investor mindset requires understanding what you own. When you buy a stock, you become a partial owner of that business. This ownership perspective changes everything. Instead of watching daily price movements, you monitor the company's financial health, competitive position, and growth prospects. You ask whether the business is generating more cash, expanding its market reach, and maintaining competitive advantages. Speculators operate differently. They focus on charts, trends, and momentum rather than business fundamentals. They might buy a cryptocurrency because its price surged 50% last week, or sell a stock because technical indicators suggest a downturn. This approach treats investments like casino chips rather than ownership stakes in real businesses. What drives your current investment decisions? Are you analyzing business performance or following price patterns? Your honest answer reveals which role you're playing. The time horizon separates investors from speculators more clearly than any other factor. Investors think in years and decades. They understand that building wealth requires patience, and that short-term volatility is the price of long-term gains. Speculators think in days, weeks, or months. They want quick results and often abandon strategies before they have time to work. Real estate provides a clear example. Property investors evaluate location fundamentals, rental income potential, and long-term demographic trends. They're comfortable holding properties for years, even decades. Real estate speculators flip houses quickly or trade real estate investment trusts based on market sentiment. The investor builds wealth through rental income and steady appreciation. The speculator faces higher transaction costs, tax consequences, and timing risks. Your risk tolerance also differs based on your role. Investors accept the risk that comes with business ownership, but seek to minimize unnecessary risks through diversification and careful analysis. They understand that avoiding all risk means accepting the certainty of inflation eroding their purchasing power. Speculators often take excessive risks chasing high returns, or avoid necessary risks due to fear of short-term losses. The grocery store owner who saves money each month and invests in a diversified portfolio of quality companies accepts reasonable business risk. The day trader who borrows money to bet on cryptocurrency movements takes speculation to dangerous extremes. Both face uncertainty, but their approaches to managing risk differ completely. Personal goals determine whether investing or speculation makes sense for your situation. If you're saving for retirement in 30 years, investing in quality businesses through diversified funds aligns with your timeline. If you need money for a house down payment next year, keeping funds in stable, liquid investments makes more sense than speculating on individual stocks. Most people struggle to identify speculative behavior in themselves. Common warning signs include checking portfolio values multiple times daily, making investment decisions based on news headlines, following hot tips from friends or social media, and frequently buying and selling based on recent performance. These behaviors indicate a speculative mindset regardless of the assets involved. The financial media often encourages speculation without realizing it. Headlines about stocks to buy now or the next big investment trend appeal to speculative instincts. Shows featuring rapid-fire trading recommendations treat investing like entertainment rather than serious wealth building. This constant noise makes maintaining an investor mindset more challenging. Why do most speculators fail over time? The evidence is overwhelming. High transaction costs eat into returns. Emotional decision-making leads to buying high and selling low. Market timing proves nearly impossible even for professionals. The average investor significantly underperforms market indices largely due to speculative behaviors. A major brokerage study revealed that their most active traders earned the lowest returns after accounting for costs. Meanwhile, accounts with the least activity, often belonging to people who forgot they owned stocks, generated the highest returns. This counterintuitive result demonstrates the cost of speculation versus the power of patient investing. Your role as investor or speculator shapes every aspect of your financial approach. Investors build systems for regular contributions, focus on asset allocation, and ignore daily market noise. Speculators chase performance, react to market movements, and constantly seek the next opportunity. One approach builds wealth steadily over time. The other typically destroys it through fees, taxes, and poor timing. The path forward requires honest self-assessment and clear goal setting. Define what you're trying to achieve, when you need the money, and how much risk you can truly handle. This foundation enables rational decision-making when markets become volatile and emotions run high. Part 2. Mr. Market's Mood Swings. Why emotions kill returns. Markets reveal their true nature through dramatic price swings that often bear little resemblance to underlying business values. Benjamin Graham's Mr. Market parable remains one of the most powerful tools for understanding this phenomenon and learning to profit from market volatility. This concept teaches investors to view market fluctuations as opportunities rather than threats, showing how emotional reactions to price movements consistently destroy wealth. By mastering these principles, you gain the ability to remain calm during market storms and make rational decisions when others act on pure emotion. Benjamin Graham introduced Mr. Market as your hypothetical business partner, who shows up at your door every day with a different mood. Some days he's optimistic and offers to buy your share of the business at a high price. Other days he's pessimistic and wants to sell his share cheaply. The key insight is that you don't have to accept his offer either way. You can simply ignore him when his prices don't make sense. Consider what happened during the 2008 financial crisis. Companies like Coca-Cola and Johnson & Johnson saw their stock prices fall by 30 to 40% despite maintaining steady earnings and strong balance sheets. Mr. Market was in a panic, offering to sell quality businesses at discount prices. Investors who recognized this emotional overreaction and bought during the fear made substantial returns over the following years. The stock market operates on this same principle every single day. Prices fluctuate based on investor emotions rather than business fundamentals. Fear drives prices below intrinsic value during downturns. Greed pushes prices far above reasonable levels during bubbles. These disconnects create opportunities for rational investors. How often do you find yourself checking stock prices during volatile periods? And what emotions surface when you see large changes? Fear and greed serve as the primary drivers of irrational market behavior. Fear causes investors to sell at exactly the wrong time, often near market bottoms when prices have already fallen substantially. This happened during the March 2020 pandemic sell-off, when many investors dumped stocks just before one of the strongest market recoveries in history. Greed operates on the opposite extreme. During the dot-com bubble of the late 1990s, investors ignored traditional valuation metrics and bought internet stocks at astronomical prices. Companies with no profits traded at market values exceeding established, profitable businesses. This euphoric buying created one of the largest wealth destruction events in market history. The pattern repeats consistently throughout market history. Emotional investors buy high during periods of optimism and sell low during periods of fear. This behavior guarantees poor returns and explains why the average investor significantly underperforms market indices over time. Recognizing your own emotional triggers represents the first step toward rational investing. Physical symptoms often precede poor investment decisions. Notice when your heart rate increases while checking portfolio values. Pay attention to the urge to act immediately after reading financial news or seeing dramatic price movements. Panic selling typically occurs after a series of declining days when paper losses mount. The fear of further losses becomes overwhelming, leading to the sale of good investments at depressed prices. This reaction ignores the fundamental principle that temporary price declines don't reflect permanent value destruction for quality businesses. Euphoric buying happens during extended bull markets when everything seems to go up. The fear of missing out drives investors to abandon their normal standards and buy anything that's rising. This behavior leads to purchasing overvalued assets just before inevitable corrections. What specific market events or news stories tend to trigger your strongest emotional reactions? Developing emotional equilibrium requires systematic approaches that remove emotion from investment decisions. Mechanical rebalancing serves as one effective strategy. Set specific dates to review and adjust your portfolio regardless of market conditions. This removes the temptation to time the market based on feelings. Dollar-cost averaging provides another method for managing emotions. Regular investments at predetermined intervals ensure you buy more shares when prices are low and fewer when prices are high. This mathematical approach eliminates the need to decide when markets are attractive. Creating written investment criteria before making any investment decision helps maintain objectivity. Define exactly what constitutes an attractive investment opportunity, including specific valuation metrics and business quality standards. Refer to these criteria during both bull and bear markets to maintain consistency. Market volatility creates the best opportunities for patient investors. When Mr. Market becomes extremely pessimistic, quality businesses often trade below their intrinsic values. These periods require courage to act while others are fearful, but they typically produce the highest long-term returns. The 2008-2009 financial crisis provides a perfect example. Banks, retailers, and industrial companies traded at fraction of book value despite maintaining viable business models. Investors who purchased during maximum pessimism achieved returns of 200 to 300% over the following 5 years. Similarly, market bubbles create opportunities to sell overvalued holdings and wait for better prices. During the tech bubble peak in 2000, selling growth stocks and buying value stocks positioned investors for superior returns during the subsequent decade. Contrarian thinking requires the mental strength to act opposite to crowd behavior. When financial media promotes certain investments heavily, consider whether prices have moved beyond reasonable levels. When doom and gloom dominate headlines, evaluate whether quality businesses are available at discount prices. This approach doesn't mean automatically opposing popular opinion. Instead, it means thinking independently and making decisions based on facts rather than emotions. Study company financial statements instead of following stock price movements. Focus on business fundamentals rather than market sentiment. Historical data supports contrarian approaches consistently. Studies show that investors who buy during periods of high fear and sell during periods of extreme optimism outperform those who follow the crowd. The key lies in developing systems that enable rational decision-making when emotions run highest. How can you create reminders or systems that help you think independently during periods of intense market emotion? Practical implementation requires establishing specific rules before emotional situations arise. Write down your investment philosophy and refer to it during volatile periods. Set maximum portfolio allocation limits to prevent overconcentration in any single investment. Define clear selling criteria to avoid holding declining investments indefinitely. Regular portfolio reviews help maintain perspective during emotional periods. Schedule monthly or quarterly assessments when you're calm and rational. Document your reasoning for each investment decision to review later. This practice helps identify emotional patterns and improve future decision-making. Building wealth through intelligent investing requires mastering your emotional responses to market volatility. Mr. Market will continue offering irrational prices daily. Your success depends on recognizing these opportunities and acting rationally when others are driven by fear or greed. The investors who profit most from market volatility are those who treat Mr. Market's mood swings as gifts rather than threats. Part 3. The Long Game. Building Wealth Through Patience. Building wealth through patience represents one of the most powerful yet underappreciated strategies in investing. While media headlines focus on daily market movements and get-rich-quick schemes capture attention, the truly wealthy understand that time and compound interest create extraordinary results for those willing to wait. This patient approach requires understanding why markets reward long-term thinking, how compound growth transforms modest investments into substantial wealth, and why psychological discipline often matters more than market knowledge. Master these principles, and you'll discover why the patient investor consistently outperforms those chasing quick profits. Time truly becomes your greatest ally when building wealth. Consider the remarkable story of Grace Groner, a secretary who worked at Abbott Laboratories for over 40 years. In 1935, she bought 3 shares of Abbott stock for $118. Instead of trading or trying to time the market, she simply held those shares and reinvested dividends. When she died in 2010, her initial $180 investment had grown to over $7 million. This transformation happened not through complex strategies or market timing, but through the simple power of patience and compound growth. Compound interest creates what Einstein allegedly called the 8th wonder of the world. When your investment returns generate their own returns, growth accelerates exponentially rather than linearly. A $10,000 investment earning 8% annually becomes $21,589 after 10 years, $46,610 after 20 years, and $100,627 after 30 years. Notice how growth accelerates over time. The final decade nearly doubles the total, demonstrating why starting early and staying invested matters tremendously. Historical market data consistently supports patient investing strategies. Between 1980 and 2020, the S&P 500 delivered positive returns in 32 out of 41 years. However, daily volatility often created the illusion of constant danger. Investors who focused on daily movements experienced stress and made poor decisions, while those maintaining long-term perspectives enjoyed steady wealth accumulation. The stock market's short-term behavior resembles a voting machine, reflecting emotions and sentiment. Over longer periods, it functions like a weighing machine, ultimately reflecting underlying business values. Market timing attempts consistently destroy investor returns. Research shows the average equity fund investor earned just 3.3% annually over a 30-year period, while the funds themselves earned 11.3%. This performance gap results from investors jumping in and out of investments at precisely the wrong times. They buy after strong performance and sell after poor performance, essentially buying high and selling low. How often do you find yourself wanting to invest after hearing success stories or wanting to sell after reading scary headlines? Transaction costs accumulate quickly for active traders. Each buy and sell decision incurs commissions, spreads, and tax consequences. Frequent trading also triggers short-term capital gains taxes, which often exceed long-term rates significantly. A patient investor holding quality investments for years minimizes these costs while maximizing compound growth potential. The money saved on fees and taxes compounds alongside the core investment returns. Consider the contrasting experiences of 2 investors during the 2008 financial crisis. Sarah panicked as markets fell, selling her entire portfolio in March 2009 near market lows. She waited until 2012 to reinvest, missing the entire recovery. Meanwhile, David maintained his long-term perspective, continuing regular investments throughout the crisis. By 2020, David's wealth had grown substantially while Sarah struggled to recover her pre-crisis levels. The difference wasn't intelligence or market knowledge, but patience and discipline. Psychological challenges test every long-term investor. Media coverage amplifies daily market movements, creating artificial urgency around investment decisions. Friends and colleagues share hot stock tips or express panic during downturns. Social media floods feeds with market predictions and get-rich-quick opportunities. Maintaining long-term focus requires conscious effort to filter out noise and stay committed to proven strategies. Successful patient investors develop specific techniques for maintaining perspective. They limit market news consumption, understanding that excessive information often leads to overconfidence and poor decisions. Regular portfolio reviews happen on predetermined schedules, not in response to market events. They maintain emergency funds separate from investments, reducing pressure to sell during difficult periods. Dollar-cost averaging exemplifies patient investing principles. Rather than trying to time perfect entry points, investors commit to regular purchases regardless of market conditions. This approach automatically buys more shares when prices fall and fewer when prices rise, often improving long-term returns while removing emotional decision-making from the process. Quality companies reward patient shareholders through dividend growth and business expansion. Johnson & Johnson has increased its dividend for 59 consecutive years, rewarding shareholders who maintained long-term holdings. Microsoft investors who held through various technology cycles enjoyed massive wealth creation as the company adapted and grew over decades. These examples illustrate how patient capital participates in genuine business growth rather than short-term price fluctuations. What specific steps will you take to maintain patience when markets test your resolve? Building systems and strategies before emotional pressure arrives proves essential for long-term success. Patient investing isn't passive. It requires active discipline and conscious commitment to proven principles that create lasting wealth. Part 4. Your Investment Philosophy Blueprint. Creating a written investment philosophy acts as your financial GPS, guiding decisions when market chaos threatens to derail your judgment. This blueprint transforms vague intentions into concrete principles that withstand emotional pressure and external noise. Your personalized philosophy becomes the foundation for consistent decision-making, helping you define clear boundaries, establish risk parameters, and maintain discipline during both market euphoria and panic. By documenting your approach before emotions take control, you create a powerful tool that keeps you focused on long-term wealth creation rather than short-term market movements. Most investors operate without a clear philosophy, making decisions based on current market conditions, hot tips, or emotional reactions. This approach leads to inconsistent results and frequent strategy changes that destroy long-term returns. Consider the investor who buys growth stocks during bull markets but switches to defensive positions during downturns, missing recovery opportunities and locking in losses. Your investment philosophy should reflect your unique circumstances, values, and objectives. Start by examining your relationship with money and risk. Some investors sleep well owning volatile growth stocks, while others prefer steady dividend-paying companies. Neither approach is superior. What matters is alignment with your personality and situation. Sarah, a 35-year-old software engineer, discovered this principle after years of inconsistent investing. She initially tried copying Warren Buffett's value approach, but found herself constantly second-guessing stock picks and selling during minor downturns. After honest self-reflection, she realized her personality favored systematic, diversified investing over individual stock selection. She shifted to a portfolio of low-cost index funds with automatic rebalancing, achieving better returns and peace of mind. What type of investor are you naturally drawn to becoming? The answer shapes your entire investment framework. Define your investment time horizon clearly. Money needed within 5 years requires different treatment than retirement funds decades away. Your philosophy should acknowledge these distinctions and guide asset allocation accordingly. Young investors can typically accept more volatility for higher expected returns, while those approaching retirement need greater capital preservation. Risk tolerance extends beyond simple questionnaires asking about comfort with losses. True risk assessment considers your ability to withstand losses financially and emotionally. A wealthy individual might handle a 50% portfolio decline differently than someone with limited savings. Your philosophy should define maximum acceptable losses and position sizes that allow comfortable sleep. Document specific criteria for investment selection. Value investors might require stocks trading below intrinsic value with strong balance sheets and competitive advantages. Growth investors could focus on companies with accelerating revenue growth and expanding market opportunities. Index investors might prioritize low costs and broad diversification. These criteria prevent impulsive decisions and maintain consistency. Establish clear selling rules within your philosophy. Many investors spend extensive time researching purchases but never define exit strategies. Some sell after achieving specific return targets, others only when fundamental business conditions deteriorate. Warren Buffett famously holds great businesses indefinitely, while other successful investors rotate based on valuation metrics. Your philosophy should address rebalancing frequency and methods. Portfolio drift occurs naturally as different investments perform differently over time. Some investors rebalance quarterly, others annually, and some use threshold-based approaches when allocations deviate significantly from targets. Choose a method that matches your involvement level and stick with it consistently. Market conditions will test every principle in your philosophy. During the 2008 financial crisis, investors with clear philosophies either maintained positions in quality investments or systematically added to portfolios at lower prices. Those without written guidelines often panicked, selling at market bottoms and missing subsequent recoveries. Consider tax implications within your investment approach. Tax-efficient investing can significantly impact long-term returns, especially in taxable accounts. Your philosophy might prioritize tax-advantaged accounts for high-turnover strategies, while using taxable accounts for buy-and-hold positions. Regular philosophy reviews ensure continued alignment with changing circumstances. Life events like marriage, children, career changes, or inheritance might require adjustments to risk tolerance, time horizon, or objectives. However, avoid frequent changes that transform philosophy into market timing. Document your philosophy in writing and review it during emotional moments. When markets crash or bubble, refer to your written principles before making changes. This simple practice prevents costly emotional decisions that derail long-term success. How will you know when your philosophy needs updating versus when you should simply stick to your plan? Your investment philosophy becomes your personal constitution, governing decisions and providing stability during uncertain times. This written framework transforms investing from reactive gambling into systematic wealth building, ensuring your financial future remains on track regardless of market conditions or external pressures. Chapter 2. The Safety First Approach. Part 1. Margin of Safety. Your financial cushion. The margin of safety stands as the most crucial principle in intelligent investing, offering protection against the inevitable mistakes and uncertainties that every investor faces. This concept acts as your financial insurance policy, creating a buffer between what you pay for an investment and what it's actually worth. By purchasing securities at significant discounts to their true value, you protect yourself from poor timing, estimation errors, and unexpected market downturns while positioning for superior long-term returns. Consider Sarah, a careful investor who discovered a profitable manufacturing company trading at $40 per share. After thorough analysis, she determined the company's intrinsic value at $70 per share based on its earnings power, assets, and growth prospects. Rather than buying immediately, Sarah applied the margin of safety principle, waiting for the price to drop to $45 before purchasing. This $25 cushion between her purchase price and calculated value protected her when the company's earnings disappointed investors 6 months later, causing the stock to fall to $35. While other investors who bought at full value suffered significant losses, Sarah's margin of safety kept her investment relatively stable. The margin of safety principle works because it acknowledges human fallibility in investment analysis. Even the most skilled investors make calculation errors, miss important information, or encounter unforeseen circumstances that affect their investments. When you buy securities at substantial discounts to their estimated worth, these inevitable mistakes become manageable rather than catastrophic. Calculating an appropriate margin of safety requires understanding several key factors. Business quality plays a fundamental role in determining how large your safety cushion should be. Companies with consistent earnings, strong competitive positions, and predictable cash flows require smaller margins of safety than volatile businesses or those facing significant competitive threats. A utility company with regulated rates and steady demand might justify a 20% margin of safety, while a technology startup could require 50% or more. Market conditions also influence margin requirements. During periods of high market valuations and widespread optimism, intelligent investors demand larger safety margins to compensate for elevated risks. Conversely, during market panics when quality companies trade at fire sale prices, smaller margins may suffice, since the market itself provides additional protection. Your confidence level in the analysis represents another critical factor. When evaluating businesses within your expertise, you might accept smaller margins due to deeper understanding. However, investments outside your knowledge require larger safety cushions to account for blind spots in your analysis. How confident do you feel about your ability to accurately value the companies in your current portfolio? The practical application of margin of safety extends beyond individual stock selection. Bond investors apply this principle by purchasing bonds trading below par value or focusing on high-quality issuers during periods of credit stress. Real estate investors seek properties priced significantly below replacement cost or comparable sales. Even index fund investors can apply margin concepts by increasing purchases during market downturns when entire asset classes trade at discounts. Consider the case of Warren Buffett's purchase of Coca-Cola stock in the late 1980s. While Coca-Cola appeared expensive by traditional metrics, Buffett recognized the company's exceptional business quality, global brand strength, and predictable cash flows. He purchased shares at what he calculated as a reasonable margin below intrinsic value based on the company's long-term earning power. Despite short-term volatility, this margin of safety allowed the investment to compound successfully over decades. Common mistakes in applying margin of safety principles often stem from inadequate intrinsic value calculations. Many investors underestimate the complexity of business valuation, relying on simple price-to-earnings ratios or book values without considering factors like competitive position, management quality, or future growth prospects. Others make the opposite error, creating overly complex valuation models that appear precise but rest on uncertain assumptions. Another frequent error involves confusing cheap prices with adequate margins of safety. A stock trading at 5 times earnings might seem like a bargain, but if the business faces permanent decline, even this low price offers no safety margin. True safety comes from buying quality businesses at discounts to their intrinsic worth, not from purchasing poor companies at low prices. The psychological aspects of maintaining margin of safety discipline present ongoing challenges. When markets rise consistently, investors often abandon safety margins in pursuit of immediate gains. The fear of missing opportunities leads to compromising on purchase prices, eliminating the protection that margins provide. Successful investors maintain discipline by remembering that markets regularly provide opportunities for those who wait patiently. During market euphoria, maintaining margin requirements can feel overly conservative. However, these periods often precede significant corrections, where margin of safety principles prove their worth. Investors who maintain discipline during good times find themselves positioned to capitalize on subsequent opportunities, while others nurse significant losses. What specific criteria will you use to determine adequate margins of safety for your future investments? The margin of safety concept adapts to different economic environments and asset classes. During inflationary periods, investors might require larger margins to account for currency depreciation and changing discount rates. In deflationary environments, the purchasing power protection becomes less critical, but credit risk increases, requiring different safety considerations. Modern portfolio theory and diversification complement but cannot replace margin of safety principles. While spreading investments across multiple securities reduces specific risks, systematic risks affect entire markets. Margin of safety provides protection against both specific and systematic risks by ensuring you don't overpay for any individual investment. Technology companies present unique challenges for margin of safety applications. Rapid change and uncertain future cash flows make traditional valuation methods difficult. However, the principle remains valid when adapted appropriately. Investors might focus on companies with strong balance sheets, multiple revenue streams, or clear competitive advantages, while demanding larger safety margins to account for technological uncertainty. The integration of margin of safety thinking into your investment process requires developing systematic approaches for valuation and purchase decisions. Creating checklists that include margin requirements, establishing price targets before researching investments, and maintaining patience when markets don't cooperate all contribute to successful implementation. Building wealth through intelligent investing depends more on avoiding significant losses than on capturing every possible gain. The margin of safety principle provides the foundation for this loss avoidance approach, ensuring that your investment decisions prioritize capital preservation while still allowing for attractive returns over time. Part 2. Risk versus uncertainty. What you can control. Making sense of investment risks requires distinguishing between what you can measure and control versus what remains inherently uncertain. Smart investors learn to manage quantifiable risks through research and diversification, while accepting that some market uncertainties simply cannot be predicted or controlled. This distinction forms the foundation for building resilient portfolios that can weather various economic storms while still generating attractive returns. Understanding which risks you can influence and which you must simply accept allows you to focus your energy and resources where they matter most, creating a systematic approach to wealth building that balances protection with growth opportunities. The difference between risk and uncertainty might seem subtle, but it dramatically affects your investment success. Risk refers to situations where you can assign probabilities to different outcomes based on historical data and analysis. When you buy a well-established company with predictable earnings, you can estimate the likelihood of various scenarios. Uncertainty, however, involves situations where the probabilities cannot be calculated because the outcomes are truly unknown. Consider the case of a pharmaceutical company developing a new drug. You can assess certain risks by examining their track record, financial strength, and research pipeline. The risk that their current cash will run out before completing trials can be calculated. The risk that competitors will launch similar products can be estimated based on industry patterns. However, the uncertainty of whether their drug will actually work remains unmeasurable until clinical trials conclude. John, a seasoned investor, learned this distinction the hard way during the 2008 financial crisis. He had carefully calculated the risk of individual bank stocks based on their historical loan performance and capital ratios. What he couldn't predict was the systemic uncertainty of a complete credit market freeze. His risk calculations proved worthless because an uncertain event changed the entire game. How do you currently distinguish between risks you can quantify and uncertainties you must simply accept in your investment decisions? Business-specific risks represent the most controllable category in your investment toolkit. These include competitive position deterioration, management changes, regulatory challenges, and operational difficulties. Through thorough research, you can assess a company's competitive advantages, evaluate management quality, understand regulatory environments, and analyze operational efficiency. While you cannot eliminate these risks entirely, you can measure their probability and potential impact. Financial risks occupy the middle ground between control and uncertainty. Debt levels, cash flow stability, and capital allocation decisions can be analyzed and compared across companies and industries. A company carrying minimal debt during economic downturns faces measurably lower financial risk than highly leveraged competitors. You can calculate debt-to-equity ratios, interest coverage ratios, and cash conversion cycles to assess financial stability. Market risks present the greatest challenge because they blend measurable elements with pure uncertainty. Interest rate changes, inflation fluctuations, and economic cycles follow patterns that allow some prediction, but their timing and magnitude often surprise even expert economists. The 2020 pandemic illustrated how quickly market uncertainty can overwhelm traditional risk models. Sarah, a portfolio manager, structures her approach around three distinct risk categories. For business risks, she conducts detailed company analysis and maintains concentrated positions in her highest conviction ideas. For financial risks, she diversifies across companies with different capital structures and financial profiles. For market risks, she accepts their uncertainty while building portfolios that can survive various economic scenarios. The relationship between risk and return forms the foundation of intelligent investing. But this relationship only works when you properly identify and price risks. Taking appropriate risks remains essential for wealth building because risk-free investments rarely keep pace with inflation over long periods. Government bonds might preserve nominal capital, but they often lose purchasing power over time. Smart risk-taking involves accepting uncertainties you cannot control while minimizing risks you can influence. This means researching companies thoroughly, diversifying across industries and geographies, maintaining adequate cash reserves, and avoiding excessive leverage. The goal is not to eliminate all risks, but to ensure that the risks you take are compensated with appropriate returns. What level of market uncertainty are you comfortable accepting in exchange for the potential of higher long-term returns? Building frameworks for risk assessment requires systematic approaches that can be applied consistently across different investments and market conditions. Start by categorizing each potential investment's risks into controllable and uncontrollable buckets. For controllable risks, develop specific criteria and analytical tools. For uncontrollable uncertainties, focus on building portfolio resilience. A practical framework begins with business quality assessment. Companies with strong competitive positions, competent management, and healthy balance sheets can better navigate both predicted risks and unpredictable uncertainties. These businesses often emerge stronger from challenging periods, providing natural protection for patient investors. Financial strength analysis forms the second layer of your framework. Companies with fortress balance sheets can survive extended difficult periods and often acquire distressed competitors at attractive prices. During the 2008 crisis, financially strong companies like Berkshire Hathaway capitalized on opportunities while over-leveraged firms struggled to survive. Diversification remains your primary tool for managing uncertainty, but it must be implemented thoughtfully. True diversification requires spreading investments across companies, industries, countries, and asset classes that respond differently to various economic scenarios. Simply owning 50 technology stocks provides little diversification because they often move together during market stress. Creating portfolios that withstand various economic scenarios involves scenario planning and stress testing. Consider how your holdings might perform during inflation, deflation, recession, rapid growth, and periods of high uncertainty. While you cannot predict which scenario will occur, you can build portfolios that survive and potentially thrive across multiple possibilities. The intelligent investor accepts that perfect prediction remains impossible while focusing on what can be controlled through careful analysis, appropriate diversification, and patient capital deployment. This approach allows you to participate in market growth while protecting against permanent capital loss, the foundation of long-term wealth building. Part 3. Portfolio Balance. The 50-50 Rule Revisited. Building a balanced portfolio requires understanding how different assets work together to create stability while capturing growth opportunities. Benjamin Graham's 50-50 allocation between stocks and bonds formed the foundation of defensive investing, but today's markets demand fresh thinking about this time-tested approach. Modern investors face challenges Graham never encountered. Historically low interest rates, global markets, alternative investments, and economic conditions that reshape traditional asset relationships. The principles remain sound, yet the application must evolve to serve contemporary financial goals while preserving the essential wisdom of balanced allocation strategies. Graham's original 50-50 rule provided a simple framework during an era when bonds yielded substantial returns and stocks traded at reasonable valuations. The logic was straightforward. Stocks provided growth potential, while bonds offered steady income and capital preservation. When one asset class struggled, the other typically provided stability. This balance protected investors from the devastating losses that come from concentrated positions, while ensuring participation in long-term wealth creation. Consider the experience of two investors during the 2008 financial crisis. Robert held a portfolio of 90% stocks and 10% bonds, believing higher stock allocation would maximize returns. Sarah maintained a 60% stock and 40% bond allocation, following modified Graham principles. When markets collapsed, Robert's portfolio dropped 45% while Sarah's declined only 28%. More importantly, Sarah's balanced approach allowed her to maintain confidence and even purchase additional assets during the downturn, while Robert panicked and sold at the worst possible time. The mathematical advantage of balanced portfolios extends beyond simple diversification. When stocks decline and bonds rise, rebalancing forces you to sell high-performing bonds and purchase discounted stocks. This systematic approach removes emotion from buying and selling decisions, while ensuring you consistently move money from expensive assets to cheaper ones. Modern market conditions challenge traditional stock-bond relationships. During periods when interest rates near zero, bonds provide little income and face significant price risk when rates eventually rise. Government bonds that once offered 5 to 7% yields now provide minimal returns, reducing their effectiveness as portfolio stabilizers. How might you adapt Graham's wisdom to an environment where traditional safe assets offer inadequate compensation for inflation risk? International diversification offers one solution to domestic market concentration. Global markets don't move in perfect harmony, providing natural hedging benefits. When U.S. stocks struggle, international markets may perform better due to different economic cycles, currency movements, or regional growth patterns. However, globalization has increased correlations during major market stress, reducing but not eliminating diversification benefits. Real estate investment trusts represent another evolution of balanced portfolio construction. REITs provide exposure to property markets that often move independently of stocks and bonds. During inflationary periods, real estate typically preserves purchasing power better than bonds, while generating income through rent payments. A modern balanced portfolio might allocate 60% to stocks, 25% to bonds, 10% to REITs, and 5% to other alternatives. The challenge intensifies when determining appropriate allocation adjustments based on market conditions. When stocks become extremely expensive relative to historical valuations, increasing bond allocations provides protection against potential declines. Conversely, when stocks trade at attractive valuations and bonds offer minimal yields, tilting toward equities makes sense. This requires ongoing assessment rather than static allocation percentages. Personal circumstances significantly influence optimal allocation decisions. A 35-year-old professional with steady income can accept higher stock allocations than a 65-year-old approaching retirement. The younger investor has decades to recover from market downturns, while the older investor needs current income and capital preservation. Graham's 50-50 rule serves as a starting point, not a rigid mandate. Treasury inflation-protected securities provide modern solutions for bond allocation challenges. TIPS adjust principal payments based on inflation rates, preserving purchasing power that traditional bonds cannot match. While TIPS may underperform during deflationary periods, they excel when inflation accelerates, providing balance against stock holdings that may struggle during inflationary environments. The rebalancing process requires discipline and systematic execution. Many investors check portfolios too frequently, making unnecessary adjustments based on short-term movements. Effective rebalancing typically occurs quarterly or semi-annually, allowing sufficient time for meaningful asset price movements while avoiding excessive trading costs. Tax considerations complicate rebalancing strategies. Selling appreciated assets in taxable accounts generates capital gains taxes, reducing rebalancing benefits. Using new contributions to restore balance, harvesting tax losses, or concentrating trading activity in tax-advantaged accounts helps minimize tax drag while maintaining desired allocations. Alternative assets increasingly play important roles in modern balanced portfolios. Commodities provide inflation protection and crisis hedging. Gold maintains purchasing power during currency devaluation periods. Private equity and hedge funds offer return potential with different risk characteristics than public markets. However, these alternatives often come with higher fees, lower liquidity, and increased complexity that individual investors must carefully evaluate. The key insight from Graham's approach remains relevant. Avoid putting all resources into any single asset class or investment theme. Markets cycle through periods favoring different assets, and maintaining balance ensures participation in these cycles while limiting exposure to any single source of risk. This approach may not maximize returns during any specific period, but it provides the foundation for long-term wealth building with acceptable risk levels. Building an effective, balanced portfolio today requires adapting timeless principles to contemporary market realities while maintaining the discipline and patience that made Graham's approach successful across generations of investors. Part 4. Defensive investing in volatile times. Market volatility creates both danger and opportunity for investors, but those who master defensive strategies can protect their wealth while positioning for long-term growth. This approach requires understanding which assets provide stability during turbulent times, how to identify companies that thrive during economic uncertainty, and when to deploy capital patiently. Smart defensive investing transforms market chaos into wealth-building opportunities through careful selection of resilient assets, strategic cash management, and disciplined timing that preserves purchasing power across economic cycles. Building a fortress around your investments starts with understanding what defensive truly means. Defensive investing does not mean avoiding all risk or hiding money under a mattress. Instead, it focuses on selecting assets that maintain value and continue generating income even when economic storms hit. Think of it as building with brick instead of wood when you know hurricanes are possible. Consumer staples companies provide excellent examples of defensive characteristics. People still need toothpaste, food, and basic household items regardless of economic conditions. Procter & Gamble weathered the 2008 financial crisis better than most companies because demand for their products remained steady. Their stock price fell much less than the broader market, and dividend payments continued without interruption. This resilience stems from the essential nature of their products and strong brand loyalty that allows them to maintain pricing power. Utilities represent another pillar of defensive investing. Electric, gas, and water companies generate predictable revenue streams because customers cannot easily reduce consumption during economic downturns. Southern Company has paid dividends consistently for over 70 years, including through multiple recessions and market crashes. Their regulated business model provides stable cash flows that support reliable dividend payments, making them valuable during uncertain times. Healthcare companies often demonstrate defensive qualities because medical needs persist regardless of economic conditions. Johnson & Johnson combines pharmaceutical development with consumer health products and medical devices, creating multiple revenue streams that rarely decline simultaneously. Their diversified healthcare approach provided stability during various economic cycles while continuing to grow long-term. What makes you confident that a company can maintain profitability during economic downturns? Consider their customer base, pricing power, and essential nature of their products or services when evaluating defensive potential. Cash management becomes critical during volatile periods, but holding too much cash creates its own risks. Inflation erodes purchasing power over time, making cash a poor long-term store of value. However, maintaining adequate cash reserves allows investors to take advantage of opportunities when quality investments become available at discounted prices. A disciplined approach involves keeping enough cash to cover living expenses and potential investment opportunities without letting inflation destroy wealth. Money market funds and short-term treasury bills provide better alternatives to checking accounts for cash reserves. These instruments offer modest returns while preserving capital and maintaining liquidity. High-yield savings accounts at stable banks also provide reasonable options for parking defensive cash while earning some return above inflation. Dividend-focused strategies play important roles in defensive portfolios because dividends provide income independent of stock price movements. Companies that consistently pay and increase dividends typically demonstrate financial strength and management commitment to shareholders. Dividend growth often continues even when stock prices decline, providing real returns during difficult market periods. Real estate investment trusts that focus on essential properties like grocery, stores, apartments, or medical facilities can provide defensive characteristics through their dividend payments. Realty Income Corporation has earned the nickname the Monthly Dividend Company by consistently paying dividends for decades, including during recessions. Their focus on long-term lease agreements with stable tenants creates predictable income streams that support reliable dividend payments. Bond selection requires careful attention during volatile times because not all bonds provide equal safety. Government bonds from stable countries offer capital preservation, but may not provide adequate returns during inflationary periods. Corporate bonds from financially strong companies can offer better yields while maintaining reasonable safety, but credit quality becomes paramount during economic stress. Treasury inflation-protected securities help maintain purchasing power during inflationary periods by adjusting principal values based on inflation rates. These bonds ensure that your investment keeps pace with rising prices, protecting the real value of your capital over time. While TIPS may underperform during deflationary periods, they provide important insurance against inflation eroding wealth. How would your current portfolio perform if we experienced another recession similar to 2008? This question helps evaluate whether your defensive preparations are adequate for potential economic challenges. International diversification adds another layer of defensive protection by spreading risks across different economies and currencies. While global markets often move together during crisis periods, different countries experience varying economic cycles that can provide stability through diversification. Established international companies with strong competitive positions in their home markets can provide growth opportunities while reducing dependence on any single economy. Timing defensive moves requires patience and discipline rather than trying to predict exact market tops and bottoms. Gradually increasing defensive positions as markets reach high valuations provides protection while maintaining growth potential. This approach avoids the impossible task of perfect timing while ensuring adequate protection when markets eventually decline. Value investing principles apply especially well during volatile periods because market stress often creates pricing inefficiencies. Quality companies may trade at discounts to their intrinsic values during panic selling, providing attractive entry points for patient investors. Maintaining investment discipline during these periods separates successful defensive investors from those who panic at the worst possible times. Building defensive positions takes time and should begin before they are needed. Waiting until crisis hits often means paying higher prices for defensive assets as other investors seek the same protection. Starting defensive preparations during calm periods allows for better selection and pricing while avoiding the emotional pressure of crisis decision-making. Market volatility will continue challenging investors, but those who prepare defensive strategies can protect wealth while positioning for recovery. Success comes from selecting resilient assets, maintaining adequate liquidity, and exercising patience during turbulent periods. These approaches transform market uncertainty from a threat into an opportunity for building lasting wealth. Chapter 3. Finding Hidden Gems. Part 1. Intrinsic Value. What companies are really worth. Understanding what a company is truly worth represents one of the most powerful skills in investing. While stock prices bounce up and down based on emotions and short-term events, a company's real value stays more stable. This section teaches you practical methods to calculate intrinsic value using proven techniques that professional investors rely on. You will learn when to use different approaches, how to test your assumptions, and ways to account for factors that make some businesses more valuable than others. These skills help you make confident investment decisions based on solid analysis rather than market noise. Think of intrinsic value as the price tag that should be on a company if markets worked perfectly. Just like a house might sell for less than its true worth during a market crash, stocks often trade below their real value during tough times. The key is knowing how to calculate that true worth independently. Sarah, a retail investor, learned this lesson when she studied Coca-Cola during the 2008 financial crisis. While the stock price fell by 30%, the company's ability to generate cash remained strong. Using valuation methods, she determined the business was worth much more than its market price. Her patient approach paid off as the stock recovered and exceeded previous highs within 2 years. The discounted cash flow method forms the foundation of most valuation approaches. This technique calculates what future cash flows are worth in today's dollars. Imagine you could buy a machine that produces $100 every year for 10 years. How much would you pay for it today? The answer depends on your required return rate and the certainty of those payments. Here's how the process works in practice. First, estimate the company's free cash flow for the next 5 to 10 years. Free cash flow represents the money left over after paying all expenses and necessary investments. Second, choose a discount rate that reflects the riskiness of the business. Safe companies might use 8%, while risky startups might require 15% or higher. Third, calculate the present value of those future cash flows and add them together. Consider how this applied to Amazon in 2001. Despite losing money on paper, the company generated positive cash flow from operations. Investors who focused on cash flow growth rather than accounting profits saw the potential early. The business reinvested heavily in infrastructure and customer acquisition, setting up decades of profitable growth. When should you use asset-based valuations instead? This approach works best for companies with significant tangible assets like real estate, machinery, or inventory. Banks, insurance companies, and manufacturing businesses often lend themselves to asset-based analysis. The method involves adding up what assets would sell for and subtracting all debts and obligations. Warren Buffett used this approach when analyzing Burlington Northern Santa Fe Railroad. He looked at the replacement cost of tracks, terminals, and equipment. Since building a new railroad network would cost far more than the company's market value, he recognized exceptional value. The acquisition proved highly successful for Berkshire Hathaway. What assumptions matter most in your calculations? Growth rates have enormous impact on final valuations. A company growing at 15% annually is worth significantly more than one growing at 5%, assuming similar risk levels. However, high growth rarely continues forever. Most businesses eventually mature and grow closer to overall economic growth rates. The discount rate also dramatically affects results. Small changes in this assumption can double or halve your valuation. Conservative investors often use higher discount rates to build in a margin of safety. This approach helps avoid overpaying even if your estimates prove too optimistic. How do you account for competitive advantages in your analysis? Companies with strong moats deserve higher valuations because their profits are more predictable. Microsoft's software ecosystem creates switching costs that protect its margins. Apple's brand loyalty allows premium pricing that competitors cannot match. These advantages justify paying higher multiples for seemingly expensive stocks. Management quality significantly influences long-term value creation. Great managers allocate capital wisely, treat shareholders fairly, and adapt to changing conditions. Poor managers destroy value through bad acquisitions, excessive compensation, or strategic mistakes. Research the track record, compensation structure, and communication style of key executives before investing. Consider how Reed Hastings transformed Netflix from a DVD rental service to a streaming giant. His willingness to disrupt his own business model, even at short-term cost, created enormous long-term value. Investors who recognized this management quality early earned exceptional returns. Sensitivity analysis helps test how robust your valuation estimates are. Create scenarios with different growth rates, discount rates, and margin assumptions. If small changes in key variables dramatically alter your conclusions, the investment might be too risky. Robust opportunities should offer attractive returns even under conservative assumptions. Professional investors often create 3 scenarios: optimistic, realistic, and pessimistic. If the pessimistic case still offers reasonable returns, the investment provides a good margin of safety. This approach helps avoid major losses from over-optimistic projections. Different industries require modified approaches to valuation. Technology companies might justify higher growth assumptions, but face faster obsolescence risks. Utilities offer predictable cash flows but limited growth prospects. Resource companies need commodity price assumptions that significantly affect results. Regular practice with these methods builds confidence and accuracy over time. Start with companies you understand well in familiar industries. Compare your calculations to current market prices and professional analyst estimates. Track your predictions to see which assumptions prove most accurate. The goal is not perfect precision, but reasonable approximation of value ranges. Markets eventually recognize value, though timing remains unpredictable. Patient investors who buy significantly below intrinsic value and hold for years typically achieve superior results compared to those chasing short-term price movements. Part 2. Price versus value. Spotting market mistakes. Smart investors know that market prices and true company values often tell completely different stories. While prices swing wildly based on emotions and news cycles, intrinsic value changes slowly with business fundamentals. This disconnect creates golden opportunities for those who can spot when markets make significant mistakes. The key lies in understanding why these gaps occur and developing systematic methods to find them before others do. Patient investors who master this skill gain access to high-quality companies at bargain prices, setting the foundation for exceptional long-term returns. Markets frequently overreact to short-term events while missing long-term value. Consider how Netflix stock plunged 35% in one day during 2022 when the company announced its first subscriber loss in over a decade. The market panicked, assuming the streaming giant's growth story was over. Yet the business fundamentals remain strong, with expanding international markets and growing revenue per user. Investors who recognize this overreaction could buy shares of a dominant company at a steep discount. Similar patterns emerge across all market segments. Technology stocks often get crushed after missing quarterly earnings by pennies, despite maintaining strong competitive positions. Retail companies see share prices crater during temporary supply chain disruptions that have minimal impact on long-term profitability. Energy companies face systematic undervaluation during environmental concerns, even when generating substantial cash flows. What drives you to sell a stock after bad news? Are you reacting to temporary setbacks or genuine threats to the business model? Small company neglect represents another recurring market mistake. Institutional investors often ignore companies below certain market capitalizations due to liquidity constraints and research coverage limitations. This creates an information gap where excellent small businesses trade at significant discounts to their larger counterparts. A regional bank with superior loan quality and management might trade at half the valuation multiple of a major national bank simply due to size bias. Seasonal patterns also create predictable opportunities. Tax loss selling in December often depresses stock prices of companies that have performed poorly during the year, regardless of their fundamental prospects. January frequently brings rebounds as new money enters the market. Retail stocks typically face pessimism during slow quarters, creating buying opportunities before seasonal strength returns. Behavioral biases systematically distort market pricing. Anchoring bias causes investors to fixate on recent price levels, preventing proper evaluation of current value. A stock that traded at $100 might seem expensive at $60, even if intrinsic value equals $80. Confirmation bias leads investors to seek information supporting existing beliefs while ignoring contradictory evidence. Herding behavior amplifies these effects as investors follow crowd sentiment rather than independent analysis. Professional money managers face additional constraints that create opportunities for individual investors. Quarterly performance pressure forces many institutions to avoid temporarily unpopular sectors or companies, even when valuations become attractive. Career risk prevents managers from buying stocks that might underperform for extended periods, regardless of long-term potential. Developing systematic screening techniques helps identify these opportunities across different market segments. Start by comparing price-to-earnings ratios within industry groups, looking for companies trading at significant discounts to peers without obvious fundamental problems. Screen for stocks hitting new lows while maintaining strong balance sheets and cash generation. Search for companies with consistent profitability, trading below book value or asset replacement costs. How do you differentiate between a genuine bargain and a value trap when screening for undervalued stocks? Technology offers powerful tools for systematic opportunity identification. Database screens can filter thousands of stocks based on multiple valuation criteria simultaneously. Historical analysis reveals which combinations of factors have produced the best results over time. Regular screening processes ensure consistent coverage of market opportunities rather than relying on random discoveries. Patience becomes crucial once you identify potential opportunities. Markets can remain inefficient for extended periods, testing investor conviction. An undervalued stock might stay cheap for months or years before gaining recognition. During this waiting period, prices might even decline further as temporary factors persist or worsen. Maintaining conviction requires thorough analysis and clear reasoning for each investment decision. Document your investment thesis in writing, including specific factors that would change your opinion. Review these regularly to ensure your original reasoning remains valid. Strong analytical foundations help resist emotional reactions to short-term price movements. Consider the example of Amazon during the 2000 technology crash. The stock fell from over $100 to under $10 as investors questioned whether online retail could ever generate profits. Those who recognized the company's growing market share, improving operational efficiency, and expanding business model could accumulate shares at incredible discounts. The business continued strengthening, while the stock price reflected maximum pessimism. Position sizing becomes critical when exploiting market mistakes. Even with careful analysis, individual opportunities might not work out as expected. Diversifying across multiple undervalued situations reduces the impact of any single disappointment while allowing successful positions to drive overall returns. Professional value investors typically hold 20 to 30 positions to balance conviction with prudent risk management. Market mistakes create the foundation for superior investment returns, but only for those prepared to act differently from the crowd. Success requires combining analytical skills with emotional discipline. The ability to buy when others are selling and hold when others are panicking separates exceptional investors from average market participants. These opportunities exist regularly for those who know how to find them. Part 3. Financial Statement Secrets. Reading between the lines. Smart investors know that financial statements contain both the obvious numbers everyone sees and the hidden truths that determine real investment outcomes. Companies can present the same underlying business performance in dramatically different ways through accounting choices, timing decisions, and presentation techniques. Learning to read between the lines reveals which businesses truly generate value versus those that merely appear profitable on paper. This detective work separates exceptional investors from those who rely solely on surface-level metrics. The ability to spot quality earnings, hidden liabilities, and sustainable competitive advantages through careful financial analysis transforms how you evaluate investment opportunities and protect your capital. Financial statements tell stories, but not always the complete truth. Consider two restaurants with identical reported profits of $100,000. The first restaurant generates this profit from steady customer growth and improved efficiency. The second achieves the same number by delaying equipment maintenance, reducing food quality, and pushing aggressive promotions that sacrifice future margins. Both show $100,000 in earnings, yet one builds long-term value while the other destroys it. This difference becomes clear through earnings quality analysis. High-quality earnings come from core business operations, repeat consistently over time, and convert reliably into cash flow. Low-quality earnings depend on one-time events, accounting adjustments, or unsustainable practices that cannot continue indefinitely. The cash flow statement reveals earnings quality better than any other document. When reported profits consistently exceed operating cash flow, questions arise about revenue recognition or expense timing. Healthy businesses typically convert 85 to 100% of their earnings into operating cash flow over multi-year periods. Companies showing persistent gaps between earnings and cash generation often face hidden problems. Revenue recognition practices offer another window into earnings quality. Software companies that recognize multi-year contracts up front, Retailers that ship products to distributors near quarter end, or manufacturers that extend payment terms to boost sales, all manipulate the timing of revenue recognition. These practices inflate current period results at the expense of future performance. How carefully do you examine the relationship between a company's reported earnings and its actual cash generation patterns? This relationship often reveals more about business quality than any other single metric. Working capital changes provide additional clues about earnings sustainability. When companies report growing profits while accounts receivable and inventory balances increase faster than sales, they may be inflating current results through looser credit policies or excessive production that creates unsold inventory. Sustainable profit growth typically maintains consistent relationships between sales and working capital components. Off-balance sheet obligations represent one of the most dangerous hidden risks in financial analysis. Operating leases, joint venture commitments, pension obligations, and contingent liabilities can create substantial future cash requirements that traditional balance sheet analysis misses completely. The footnotes to financial statements contain these crucial details that many investors ignore. Consider a retail chain that reports minimal debt on its balance sheet but operates through extensive store leases. These lease obligations create fixed costs similar to debt payments but receive different accounting treatment. When evaluating debt capacity or financial flexibility, the economic reality includes both reported debt and lease commitments. Pension and post-retirement benefit obligations create similar hidden liabilities. Companies with underfunded pension plans face future cash requirements that may not appear clearly in current financial statements. These obligations become particularly important during economic downturns, when investment returns disappoint and contribution requirements increase. Ratio analysis gains power when applied consistently across time periods and compared with industry benchmarks. Return on equity trends reveal whether profitability improvements come from operational efficiency or increased financial leverage. Companies that boost ROE primarily through higher debt levels create additional risk without necessarily improving underlying business performance. Gross margin trends indicate competitive position strength better than many other metrics. Businesses with sustainable competitive advantages typically maintain stable or improving gross margins even during difficult periods. Companies experiencing consistent gross margin pressure often face intensifying competition or cost inflation they cannot pass through to customers. Asset turnover ratios help distinguish between capital-intensive businesses that require continuous investment and asset-light models that generate returns without substantial reinvestment needs. Understanding these differences proves crucial when comparing companies across different industries or business models. What patterns do you notice when comparing how different companies in the same industry manage their working capital and generate returns on invested capital? Industry analysis adds context that makes financial statement analysis more meaningful. Technology companies naturally carry different debt levels, inventory turnover rates, and depreciation patterns compared to utilities or manufacturing businesses. Understanding normal ranges for key metrics within specific industries helps identify companies that outperform or underperform their competitive environment. Seasonal businesses require multi-year analysis to identify true performance trends. Retailers, construction companies, and agricultural businesses show natural quarterly variations that can obscure underlying business health when viewed in isolation. Rolling four-quarter comparisons and multi-year trend analysis provide clearer pictures of fundamental performance. Competitive advantage identification through financial analysis requires examining profit margins, returns on capital, and cash generation patterns over complete business cycles. Companies with genuine competitive moats typically maintain above-average profitability even during industry downturns. They often show consistent cash generation that funds growth without requiring external financing. Management quality assessment emerges through careful examination of capital allocation decisions, acquisition integration success, and consistency between management statements and actual results. Companies that consistently deliver on guidance, maintain conservative accounting practices, and generate returns above their cost of capital demonstrate management teams worthy of investor confidence. The relationship between capital expenditures and depreciation reveals whether companies invest adequately in business maintenance. When capital spending consistently falls below depreciation expense, businesses may be underinvesting in necessary equipment or infrastructure updates. This practice can temporarily boost cash flow while creating future operational problems. Financial statement analysis transforms from mechanical calculation into strategic business evaluation when combined with industry knowledge and competitive analysis. The numbers provide the foundation, but understanding the business context gives meaning to the metrics and ratios that determine long-term investment success. Part 4. Red flags and warning signs. Smart investors know that spotting trouble early can save more money than finding the next big winner. Warning signs often appear months or years before major losses occur, but most investors miss these signals or ignore them due to emotional attachment. Learning to recognize red flags transforms reactive investors into proactive wealth protectors who cut losses quickly and preserve capital for better opportunities. This systematic approach to risk recognition becomes your financial immune system, identifying threats before they damage your portfolio permanently. Sarah Martinez thought she had found the perfect growth stock when she invested heavily in a popular restaurant chain in 2019. The company reported steady revenue growth, opened new locations quarterly, and management painted an optimistic picture during earnings calls. However, subtle warning signs were already present that she failed to notice. Same-store sales growth had been declining for 3 consecutive quarters, hidden beneath the headline revenue increases from new openings. Customer traffic counts, buried deep in quarterly reports, showed a concerning downward trend that contradicted management's positive narrative. Management integrity issues often surface through inconsistencies between words and actions. When executives consistently sell large portions of their personal holdings while publicly expressing confidence about future prospects, this creates a significant red flag. Companies that frequently change accounting methods, auditors, or key personnel without clear explanations deserve immediate scrutiny. Press releases that emphasize non-standard financial metrics while downplaying traditional measures like net income or cash flow suggest potential manipulation of investor perceptions. Enron's collapse provides a classic example of management integrity problems that careful observers could have spotted years before the bankruptcy. The company's executives regularly appeared at investor conferences promoting complex business models that few analysts fully understood. When questioned about specific financial details, management often provided evasive answers or redirected conversations toward growth projections. Insider selling accelerated significantly in the months before the collapse, while public statements remained overwhelmingly positive about company prospects. Have you ever noticed a disconnect between what company executives say in interviews and what their personal trading activity suggests about their true confidence levels? Financial statement irregularities manifest in various forms that trained investors can identify through careful analysis. Revenue recognition problems often appear when companies book sales before delivering products or providing services completely. Accounts receivable growing faster than sales indicates potential collection problems or aggressive revenue recognition practices. Frequent restatements of previously reported financial results signal weak internal controls or deliberate manipulation attempts. WorldCom's accounting fraud involved capitalizing routine operating expenses as capital investments, artificially inflating profits for several years. Alert investors could have noticed that the company's capital expenditures seemed unusually high relative to industry peers, while operating margins appeared suspiciously stable despite intense competitive pressures in the telecommunications industry. The disconnect between reported profitability and actual cash generation should have triggered additional investigation. Deteriorating business fundamentals often emerge gradually through multiple metrics rather than single dramatic changes. Market share erosion, declining customer retention rates, increasing customer acquisition costs, and falling profit margins per unit all signal potential long-term problems. Companies that consistently miss their own guidance or frequently revise expectations downward demonstrate poor internal forecasting capabilities or deliberate sandbagging of investor expectations. Kodak's decline illustrates how external technological threats can undermine established business models despite strong historical performance. Digital photography adoption accelerated throughout the early 2000s, yet Kodak management continued investing heavily in traditional film processing infrastructure. Revenue from core film products declined steadily, while management publicly minimized the digital transition's impact on profitability. Investors who recognized this technology shift early avoided massive losses as the company eventually filed for bankruptcy. Industry-specific warning signs require understanding sector dynamics and competitive forces unique to each business area. Retail companies showing declining same-store sales, increasing inventory levels, or growing store closure announcements face fundamental challenges. Technology companies with slowing user growth, declining engagement metrics, or increasing customer churn rates may be losing competitive advantages. Manufacturing businesses experiencing rising input costs, supply chain disruptions, or excess capacity utilization problems often struggle with profitability pressures. The newspaper industry's decline demonstrates how external factors can systematically destroy entire business models. Classified advertising revenue, once a reliable profit source, migrated to online platforms like Craigslist and job websites. Circulation numbers declined consistently as readers shifted to digital news sources. Despite these clear trends, many newspaper companies continued operating under traditional assumptions about advertising demand and subscription growth, leading to widespread bankruptcies and consolidations. What external trends in your investment holdings industries might threaten their current business models over the next 5 to 10 years? Creating systematic monitoring approaches prevents emotional decision-making when warning signs accumulate. Develop quarterly checklists that examine key performance indicators specific to each industry and company. Track management turnover rates, insider trading patterns, customer satisfaction scores, and competitive positioning metrics. Set predetermined thresholds that trigger additional research or position reduction decisions before problems become severe. Successful monitoring requires distinguishing temporary setbacks from permanent business impairments. Cyclical industries naturally experience periodic downturns that create temporary earnings declines without damaging long-term competitive positions. Economic recessions, supply chain disruptions, or regulatory changes may temporarily impact profitability while leaving underlying business models intact. However, structural changes in consumer behavior, technological obsolescence, or fundamental shifts in industry dynamics often create permanent value destruction. The key to effective warning sign recognition lies in maintaining objective analysis, despite emotional attachment to investments. When multiple red flags appear simultaneously, the probability of significant problems increases exponentially. Smart investors develop the discipline to sell positions when fundamental investment theses change, even when hoping for business turnarounds that may never materialize. Regular portfolio reviews using standardized checklists help identify emerging problems before they become major losses. This systematic approach protects capital while maintaining focus on finding genuinely attractive investment opportunities that meet strict quality standards. Chapter 4: The Modern Value Hunter. Part 1: Digital Age Analysis, Tools for Today's Investor. Modern technology transforms how value investors research and analyze investment opportunities. Today's investor can access more financial data in 5 minutes than Benjamin Graham could gather in months. However, this digital advantage comes with challenges. The key lies in using technology to enhance traditional value principles while avoiding the trap of information overload. Smart investors combine cutting-edge analytical tools with time-tested fundamental analysis to identify undervalued companies more efficiently than ever before. Sarah Martinez spent years manually reviewing annual reports and calculating financial ratios by hand. As a dedicated value investor, she believed technology would compromise her analytical discipline. Her research process took weeks for each potential investment. When she finally integrated modern screening tools with her traditional approach, her efficiency increased dramatically without sacrificing quality. She now identifies promising candidates in hours rather than weeks, spending more time on deep fundamental analysis of her best prospects. Modern financial databases serve as the foundation for efficient value investing research. Platforms like FactSet, Bloomberg Terminal, and Morningstar Direct provide instant access to decades of financial statements, key ratios, and peer comparisons. These tools eliminate the tedious work of data collection, allowing investors to focus on analysis and interpretation. Consider how screening technology revolutionizes opportunity identification. Traditional value screens look for companies with low price-to-book ratios, reasonable price-to-earnings multiples, and strong balance sheets. Modern screening tools can process these criteria across thousands of companies simultaneously. An investor can screen for companies trading below book value with debt-to-equity ratios under 0.3 and return on equity above 15% in seconds. The power extends beyond basic screens. Advanced filtering allows investors to exclude companies in declining industries while focusing on sectors with tailwinds. Geographic filters help identify opportunities in specific markets. Size filters can focus searches on small-cap stocks where inefficiencies are more common. Have you considered how much time you currently spend gathering basic financial data that could be automated? This freed time could be redirected toward qualitative analysis that creates real investment edge. Artificial intelligence and machine learning increasingly supplement traditional fundamental analysis. These technologies excel at pattern recognition and processing vast amounts of unstructured data. AI can analyze thousands of earnings call transcripts to identify management tone changes or scan news articles for emerging risks. However, technology cannot replace human judgment in value investing. AI might flag a company with deteriorating margins, but human analysis determines whether this represents a temporary challenge or permanent competitive decline. Machine learning can identify unusual trading patterns, but experienced investors must interpret whether these patterns signal opportunity or danger. Portfolio monitoring technology provides real-time insights into holdings performance and risk exposure. Modern platforms track individual position sizes, sector concentrations, and geographic allocations automatically. Risk management tools alert investors when portfolios drift from target allocations or when individual positions become oversized. Consider James Wilson, who managed a concentrated value portfolio using spreadsheets for position tracking. Market movements frequently pushed his largest positions above prudent concentration limits before he noticed. Portfolio monitoring software now alerts him immediately when any position exceeds 8% of total assets, allowing for timely rebalancing decisions. Alternative data sources provide competitive advantages for modern value investors. Satellite imagery tracking retail parking lots can reveal consumer traffic trends before quarterly earnings reports. Credit card transaction data offers real-time insights into company revenues. Patent filings indicate research and development directions and competitive positioning. Social media sentiment analysis adds another layer of market intelligence. While short-term sentiment often creates noise, persistent negative sentiment toward fundamentally strong companies can create value opportunities. Conversely, excessive enthusiasm might signal overvaluation risks. The challenge lies in integrating alternative data without becoming overwhelmed. Successful investors develop frameworks for evaluating which data sources provide genuine insights versus mere noise. They focus on alternative data that confirms or challenges their fundamental analysis rather than relying on it exclusively. Mobile technology enables continuous market monitoring without constant distraction. Smart notifications can alert investors to significant price movements in portfolio holdings or screens flagging new opportunities. However, successful value investors resist the temptation for constant monitoring, recognizing that daily price fluctuations rarely reflect fundamental business changes. Cloud-based research platforms allow investors to access their analysis from anywhere while maintaining comprehensive research files. Collaborative features enable investment teams to share research and analysis efficiently. Version control ensures that updates to financial models and research notes are tracked and accessible. What alternative data sources might provide insights into the industries or companies you follow most closely? Could satellite data, patent filings, or employment trends offer valuable confirmation of your investment thesis? Automation handles routine portfolio tasks while preserving human decision-making for critical choices. Dividend reinvestment can occur automatically based on predetermined rules. Rebalancing alerts can trigger when allocations drift beyond target ranges. Tax loss harvesting tools can identify optimization opportunities. Modern valuation models incorporate real-time data feeds, updating intrinsic value calculations as new information becomes available. Sensitivity analysis tools show how changes in key assumptions affect valuations. Monte Carlo simulations help investors understand potential outcome ranges and associated probabilities. The integration of technology with traditional value investing requires disciplined implementation. Tools should enhance existing processes rather than replace fundamental analysis. Screens should generate ideas for further research, not automatic buy decisions. Alternative data should supplement traditional financial analysis, not substitute for it. Successful modern value investors maintain healthy skepticism toward technological solutions. They verify alternative data against traditional sources. They test screening criteria against historical performance. They regularly audit their technology-enhanced processes to ensure they still serve fundamental investment goals. The digital age offers unprecedented tools for value investors willing to adapt their methods thoughtfully. Technology amplifies the effectiveness of traditional analysis while opening new sources of competitive advantage. However, the core principles of value investing remain unchanged. Buy good businesses at reasonable prices based on thorough fundamental analysis. Part 2. ESG and Value: Sustainable Investing Principles. Modern investors face increasing pressure to consider environmental, social, and governance factors alongside traditional financial metrics. ESG investing has evolved from a niche approach to a mainstream requirement, with trillions of dollars now managed under ESG mandates. Value investors must adapt their analysis to include these factors without abandoning core principles of buying good businesses at reasonable prices. ESG considerations often reveal risks and opportunities that traditional financial statements miss, making them valuable tools for identifying long-term value. Smart integration of ESG factors can enhance returns while reducing portfolio risk through better assessment of management quality, operational efficiency, and stakeholder relationships. The relationship between ESG factors and financial performance has become increasingly clear through extensive research and real-world examples. Companies with strong governance structures typically demonstrate better capital allocation decisions and reduced agency costs. Environmental considerations often translate directly into operational efficiency and cost savings. Social factors reflect management's ability to maintain productive relationships with employees, customers, and communities. Consider the case of a major retailer that ignored labor practices in its supply chain. When workplace violations surfaced, the company faced boycotts, regulatory fines, and reputation damage that destroyed billions in market value. Traditional financial analysis might have missed these risks, focusing only on quarterly earnings and balance sheet metrics. An ESG-aware investor would have identified warning signs in the company's supplier relationships and labor practices. Environmental factors present both risks and opportunities that directly impact long-term value creation. Companies operating in water-stressed regions face increasing costs and regulatory pressure. Those investing in energy efficiency often achieve significant cost reductions over time. A chemical manufacturer might appear profitable based on traditional metrics while ignoring environmental liabilities that could cost hundreds of millions in future cleanup expenses. How might environmental regulations in your target industries create competitive advantages for some companies while threatening others? The answer often lies in examining which companies have proactively invested in sustainable practices versus those that have deferred necessary investments. Governance analysis reveals management quality in ways that financial statements cannot capture. Board independence, executive compensation alignment, and transparency in reporting all indicate how well management serves shareholder interests. Poor governance often leads to value destruction through empire building, excessive risk-taking, or outright fraud. A technology company with impressive growth metrics might hide serious governance red flags. Examining board composition, audit committee independence, and management stock ownership can reveal whether leadership priorities align with long-term value creation. Companies with strong governance structures typically outperform peers over extended periods, making governance analysis a valuable tool for value investors. Social factors encompass relationships with employees, customers, suppliers, and communities. These relationships directly impact business sustainability and growth potential. Companies with engaged workforces typically show higher productivity and lower turnover costs. Strong customer relationships create pricing power and reduce marketing expenses. Positive community relations can facilitate expansion and reduce regulatory friction. The integration of ESG factors requires practical frameworks that maintain focus on fundamental analysis. Start by identifying material ESG factors specific to each industry. Energy companies face different environmental risks than software companies. Retail businesses have different social considerations than manufacturing firms. Develop a systematic approach to evaluate ESG risks within your existing analysis framework. When examining a potential investment, assess whether ESG factors could materially impact future cash flows, competitive position, or regulatory environment. This assessment should complement traditional financial analysis rather than replace it. What ESG factors in your investment targets could significantly impact their competitive position over the next decade? Consider both risks that could destroy value and opportunities that could create sustainable competitive advantages. ESG screening can help identify investment opportunities while avoiding potential value traps. Companies with strong ESG practices often demonstrate superior management quality and operational efficiency. They typically face lower regulatory risks and maintain better stakeholder relationships. These factors contribute to more predictable cash flows and sustainable competitive advantages. However, avoid paying excessive premiums for ESG attributes alone. Strong ESG practices should support fundamental value creation rather than justify high valuations. The goal remains finding good businesses at reasonable prices, with ESG factors serving as additional tools for assessment rather than primary investment criteria. Case studies demonstrate how ESG integration enhances traditional value analysis. A utility company might appear attractive based on dividend yield and stable earnings. ESG analysis reveals the company's coal plants face accelerating retirement schedules due to environmental regulations. This information helps estimate future capital requirements and earnings sustainability more accurately. Conversely, a manufacturing company investing heavily in automation and worker training might show temporarily reduced earnings. ESG analysis reveals these investments improve working conditions, reduce turnover, and increase productivity. Understanding these dynamics helps distinguish between temporary earnings pressure and fundamental business improvement. Practical implementation requires building ESG considerations into existing investment processes. Incorporate governance analysis when evaluating management quality. Consider environmental factors when assessing operational risks and opportunities. Evaluate social factors when analyzing competitive position and stakeholder relationships. Modern value investing benefits from this broader perspective on business analysis. ESG factors provide additional insight into management quality, operational efficiency, and long-term sustainability. They help identify risks and opportunities that traditional financial analysis might overlook. Most importantly, they support the fundamental goal of finding businesses capable of creating sustainable value over time. The key lies in thoughtful integration rather than wholesale replacement of traditional methods. ESG factors should enhance your understanding of business fundamentals rather than distract from core value investing principles. Part 3. Global Opportunities. Beyond your home market. International markets hold vast opportunities for discovering undervalued companies that domestic investors might miss entirely. Smart investors who limit themselves to home markets leave substantial value on the table, while those who expand globally often find better prices, stronger businesses, and more diverse growth prospects. This global approach requires mastering new analytical skills, understanding different regulatory environments, and managing additional risks that don't exist in domestic investing. The rewards justify the effort when you apply disciplined value principles across borders, while respecting the unique challenges each market presents. The foundation of global value investing starts with understanding why opportunities exist across different markets. Information flows vary dramatically between countries, creating pricing inefficiencies that patient investors can exploit. A pharmaceutical company trading at attractive valuations in Germany might remain unknown to American investors, while a solid manufacturing business in South Korea could offer better value than similar companies trading at premium prices in more popular markets. Consider the experience of investors who discovered Japanese companies during the 1970s, long before these businesses became mainstream investments. Early adopters found exceptional values in companies with strong balance sheets, conservative management, and growing market positions. These investors benefited not just from business growth, but also from multiple expansion as global awareness increased. Currency considerations add complexity, but also opportunity to international investing. Currency movements can either enhance or diminish returns, requiring careful analysis of exchange rate trends and their impact on business fundamentals. Companies generating revenue in stronger currencies while maintaining cost structures in weaker currencies often provide natural hedges that domestic companies cannot match. Have you considered how currency fluctuations might actually improve the attractiveness of certain international investments during specific economic cycles? Political and regulatory risks demand serious attention when evaluating international opportunities. Each country presents unique challenges, ranging from changing tax policies to regulatory shifts that could impact business operations. However, these risks often create the very mispricings that value investors seek to exploit. Markets frequently overreact to political uncertainty, creating opportunities for investors willing to look past short-term noise. The key lies in distinguishing between temporary political disruption and fundamental changes that permanently impair business value. A telecommunications company facing regulatory scrutiny might see its stock price decline sharply, but if the underlying business model remains intact and the company maintains competitive advantages, this could represent an attractive entry point. Analyzing foreign companies requires adapting traditional methods to different accounting standards and business practices. Financial statements prepared under international standards might present information differently than domestic reports, requiring investors to understand these variations and make appropriate adjustments. Cultural differences in business practices also influence how companies operate and communicate with shareholders. Access to international markets has become significantly easier through modern brokerage platforms and exchange-traded funds. Individual investors can now purchase shares directly in many foreign markets or gain exposure through American depository receipts that trade domestically. Each approach offers different advantages regarding convenience, costs, and tax implications. Emerging markets present particularly compelling opportunities for value investors willing to accept higher risks for potentially greater rewards. These markets often feature less efficient pricing, fewer institutional investors, and growing economies that can drive substantial business growth over time. However, they also involve greater political risks, less developed regulatory frameworks, and higher volatility. The Brazilian market during the early 2000s exemplified these dynamics perfectly. Political uncertainty and economic challenges created significant opportunities for investors who could identify solid businesses trading at depressed valuations. Those who focused on companies with strong competitive positions and conservative balance sheets often achieved exceptional returns as conditions improved. Comparing valuations across different markets requires understanding local economic conditions, growth prospects, and risk profiles. A price-to-earnings ratio of 12 might represent expensive territory in a slow-growth developed market, while indicating attractive value in a rapidly expanding economy. Interest rates, inflation expectations, and economic growth rates all influence appropriate valuation levels. Building globally diversified portfolios demands balancing value opportunities with risk management principles. Concentration in any single country or region violates fundamental diversification principles regardless of how attractive individual opportunities might appear. The goal involves capturing value across multiple markets while maintaining appropriate geographic and sector diversification. Risk management becomes more complex with international investing, but follows similar principles. Position sizing should reflect the additional uncertainties involved in foreign markets, and portfolio construction should account for correlations between different international holdings. Economic crises often impact multiple countries simultaneously, reducing the diversification benefits investors expect. What specific steps could you take today to begin researching international value opportunities while maintaining your current risk management standards? Technology has simplified international research and monitoring significantly. Financial databases now provide standardized information for companies worldwide, while translation services help investors access local news and analysis. These tools level the playing field between individual and institutional investors seeking global opportunities. The most successful global value investors maintain the same disciplined approach they apply domestically while adapting to local market conditions. They focus on businesses with sustainable competitive advantages, conservative balance sheets, and competent management teams. Regardless of geographic location, the principles remain constant even as the specific challenges and opportunities vary by market. Success in global value investing requires patience, discipline, and continuous learning about different markets and cultures. The additional complexity demands higher conviction levels and more thorough research, but the expanded opportunity set often provides better values than purely domestic investing can offer. Part 4. Tech stocks and traditional value technology companies present unique challenges for value investors who built their expertise analyzing traditional businesses with tangible assets and predictable cash flows. Modern value investing requires adapting time-tested principles to evaluate companies whose primary assets exist as lines of code, user networks, and intellectual property. This evolution demands new analytical frameworks while preserving the disciplined approach that protects investors from speculative excess. The most successful value investors today learn to recognize genuine technology value opportunities while avoiding the hype cycles that regularly inflate and deflate tech valuations. Mastering this balance opens access to some of the market's most compelling long-term investment opportunities. Sarah Martinez learned this lesson during the dot-com crash of 2000. As a portfolio manager focused on traditional value stocks, she watched technology shares collapse while her utility and manufacturing holdings remained stable. However, she noticed that companies like Microsoft and Oracle, despite losing 60 to 70% of their market value, continued generating substantial cash flows and maintaining dominant market positions. These businesses possessed characteristics she recognized from successful investments in other sectors, just packaged differently. The fundamental challenge lies in valuing intangible assets that don't appear on traditional balance sheets. When Amazon traded at seemingly astronomical price-to-earnings ratios in its early years, many value investors dismissed it as overvalued. Those who looked deeper discovered a business systematically building competitive advantages through customer relationships, logistics networks, and technology infrastructure. The company was investing heavily in future growth rather than maximizing current profits. Consider how network effects create powerful competitive moats in technology businesses. Facebook's social network becomes more valuable as more people join, creating a self-reinforcing cycle that competitors struggle to break. This network effect functions similarly to the location advantages that make prime real estate valuable, except digital networks can scale globally without proportional increases in fixed costs. Have you considered how the businesses you currently analyze might benefit from similar network effects or platform dynamics? Traditional value metrics require modification when applied to technology companies. Price-to-book ratios become less meaningful when a company's primary assets are software algorithms and user data rather than factories and inventory. Instead, revenue multiples, price-to-free cash flow ratios, and enterprise value-to-sales comparisons often provide better valuation frameworks for technology businesses. Netflix provides an excellent case study in adapting value principles to technology investing. During its transition from DVD by mail to streaming, the company appeared expensive using traditional metrics. However, investors who analyzed subscriber acquisition costs, lifetime customer value, and content amortization schedules could see the business model's underlying profitability. The streaming platform created recurring revenue streams with high switching costs, characteristics that value investors prize in any industry. Management quality becomes even more critical in fast-moving technology sectors. Leaders must allocate capital effectively between growth investments and current profitability while adapting to rapid technological changes. Jeff Bezos at Amazon demonstrated this balance by consistently choosing long-term value creation over short-term earnings, investing in infrastructure and new business lines that eventually generated substantial returns. The key is distinguishing between companies building sustainable competitive advantages and those riding temporary technological waves. True technology value investments often involve businesses that solve fundamental problems more efficiently than existing solutions. PayPal simplified online payments, reducing friction in digital commerce. Google organized the world's information more effectively than existing search engines. These companies created lasting value by addressing genuine market needs. What fundamental problems do the technology companies you're considering actually solve for their customers? Valuation techniques must account for the optionality embedded in many technology businesses. A company might appear overvalued based on current operations, but could be undervalued when considering potential expansion into adjacent markets. Amazon's e-commerce platform provided the foundation for Amazon Web Services, creating value that wasn't apparent in early valuations focused solely on book sales. Risk assessment requires understanding technology-specific threats alongside traditional business risks. Platform businesses face regulatory scrutiny as they grow larger and more influential. Hardware companies must navigate rapid product cycles and component cost fluctuations. Software businesses worry about security breaches and changing customer preferences. The most successful technology value investors develop frameworks that capture these unique characteristics while maintaining investment discipline. They focus on companies with strong balance sheets, capable management teams, and sustainable competitive positions, just like traditional value investors. The difference lies in recognizing how these qualities manifest in technology businesses. Consider Berkshire Hathaway's investment in Apple, which Warren Buffett initially avoided as outside his circle of competence. Eventually, he recognized Apple as a consumer products company with extraordinary brand loyalty and ecosystem effects rather than just a technology stock. This perspective allowed him to apply traditional value analysis to what others saw as a complex technology investment. The balance between growth and value becomes crucial when evaluating technology companies. High growth rates can justify premium valuations, but only when supported by sustainable competitive advantages and large addressable markets. The challenge lies in distinguishing between companies growing because they've identified genuine opportunities and those growing because investors reward growth, regardless of profitability prospects. Remember that even in technology investing, the margin of safety principle remains essential. Buying wonderful businesses at fair prices beats buying fair businesses at wonderful prices, regardless of the sector. The key is learning to recognize wonderful technology businesses and understanding how their unique characteristics create lasting value for patient investors. Chapter 5. Building Your Wealth Machine. Part 1. Portfolio Construction. Your Investment Architecture. Portfolio construction represents the bridge between theoretical knowledge and practical wealth building, where individual investment decisions transform into a coherent strategy designed to compound wealth over decades. Most investors focus intensely on picking individual stocks, while neglecting the crucial architecture that determines whether their carefully researched investments actually deliver meaningful returns. The difference between random stock accumulation and systematic portfolio construction often separates successful long-term investors from those who struggle despite finding quality companies. This systematic approach requires understanding how different investments interact, how much weight each position should carry, and how to maintain balance as markets evolve and personal circumstances change. Consider the case of two investors who both identified Microsoft, Johnson & Johnson, and Berkshire Hathaway as excellent long-term investments in 2010. The first investor allocated equal amounts to each position and never adjusted, while the second constructed a broader portfolio with these as core holdings, diversified across additional sectors, and systematically rebalanced. By 2020, despite owning identical high-quality companies, their outcomes differed dramatically due to portfolio construction choices rather than stock selection ability. The foundation of intelligent portfolio construction begins with correlation analysis, which reveals how different investments move relative to each other during various market conditions. Two technology companies might appear diversified on paper, but often decline together during sector-wide sell-offs. Similarly, a portfolio heavily weighted toward consumer discretionary stocks may seem balanced across multiple companies, but lacks true diversification when economic uncertainty hits. Successful investors use correlation data to build positions that provide different sources of return and risk. A portfolio might include a utility company that performs well during recessions, a technology growth stock that benefits from innovation cycles, and a consumer staples company that delivers steady cash flows regardless of economic conditions. The key lies not in owning companies from different sectors, but in owning companies whose business results depend on different economic drivers. Position sizing represents another critical element where many intelligent investors stumble. The most common mistake involves treating all investments equally, regardless of conviction level or risk characteristics. This approach ignores the reality that some investments offer better risk-adjusted returns than others, and some deserve larger allocations based on thorough analysis and high confidence levels. A practical framework allocates positions based on three factors: conviction level, risk assessment, and correlation with existing holdings. High conviction positions in well-understood businesses with strong competitive advantages might warrant 5 to 8% allocations, while newer additions or higher risk opportunities might start at 2 to 3% positions. This approach allows investors to benefit more significantly from their best ideas while limiting damage from inevitable mistakes. The core satellite approach provides an elegant solution for balancing concentrated conviction with broad diversification. Core positions represent 60 to 80% of the portfolio and focus on high-quality, well-researched companies with predictable business models and strong competitive positions. These might include established dividend growers, market leaders with wide economic moats, or consistently profitable businesses trading at reasonable valuations. Satellite positions comprise the remaining 20 to 40% and allow for more concentrated bets, emerging opportunities, or specialized strategies. These might include smaller companies with exceptional growth prospects, turnaround situations, or cyclical businesses purchased at attractive valuations. This structure provides stability through core holdings while enabling enhanced returns through selective concentration. What specific criteria do you use to distinguish between core and satellite positions in your current investment approach? Factor-based investing adds another dimension to portfolio construction by ensuring exposure to different sources of return beyond individual company selection. Value factors favor companies trading below their intrinsic worth. Quality factors emphasize businesses with strong financial metrics and competitive advantages. And momentum factors capture companies with improving business trends. Rather than explicitly constructing factor portfolios, intelligent investors naturally incorporate these elements through stock selection. A portfolio might include deep value opportunities, high-quality compounders, and businesses experiencing positive momentum shifts. This diversification across return factors provides multiple paths to outperformance and reduces dependence on any single investment style performing well. Rebalancing maintains portfolio architecture over time as individual positions grow or decline relative to their intended allocations. Many investors struggle with rebalancing because it requires selling winners and buying losers, which feels counterintuitive. However, systematic rebalancing enforces buy low, sell high behavior and prevents any single position from dominating portfolio risk. Effective rebalancing uses both time-based and threshold-based triggers. Annual rebalancing provides regular portfolio maintenance, while threshold-based rebalancing acts when positions deviate significantly from target allocations. A position that grows from 5% to 8% of the portfolio might trigger partial selling, while a position that declines from 5% to 2% might warrant additional purchases if the investment thesis remains intact. Tax considerations significantly impact portfolio construction decisions, particularly for taxable accounts. Asset location strategies place tax-inefficient investments in tax-deferred accounts while keeping tax-efficient holdings in taxable accounts. High turnover strategies work better in retirement accounts, while buy-and-hold positions suit taxable accounts where long-term capital gains receive favorable treatment. Tax loss harvesting provides additional benefits by realizing losses to offset gains while maintaining desired portfolio exposure. An investor might sell a declining bank stock to realize losses while purchasing a different bank stock with similar characteristics, maintaining sector exposure while capturing tax benefits. Portfolio structure must evolve as wealth grows and circumstances change while maintaining core value investing principles. Younger investors might emphasize growth companies and accept higher volatility, while older investors might focus more heavily on dividend-paying stocks and capital preservation. Wealthy investors might concentrate more heavily in their best ideas, while investors with smaller portfolios might emphasize broader diversification. The key lies in maintaining systematic approaches that prevent emotional decision-making while adapting to changing circumstances. A well-constructed portfolio serves as a wealth-building machine that compounds returns over decades through systematic stock selection, intelligent diversification, and disciplined maintenance. This architecture transforms individual investment decisions into a coherent strategy designed to build meaningful wealth over time. How does your current portfolio structure reflect your investment timeline and risk tolerance? And what adjustments might better align with your long-term wealth-building goals? Part 2. Dividend Champions. Income that grows. Finding companies that pay steady dividends and increase them regularly can transform your investment returns from simple capital appreciation into a powerful income-generating machine. Dividend-paying stocks offer something unique in the investment world. They provide immediate cash returns while potentially growing in value over time. This dual benefit becomes especially valuable during market downturns, when stock prices may fall, but dividend payments continue to arrive in your account. Understanding how to identify truly sustainable dividend policies separates successful income investors from those who fall into common traps that can devastate their portfolios. Consider the story of two investors who began their journeys in 2008. Sarah focused solely on capital appreciation, buying growth stocks with no dividend payments. Michael built a portfolio of established companies with track records of increasing their dividends annually. During the 2008 financial crisis, both watched their portfolio values drop significantly. However, Michael continued receiving quarterly dividend payments that totaled nearly 4% of his initial investment annually. These payments provided psychological comfort during the market chaos and actual cash he could reinvest at lower prices. By 2020, Michael's dividend payments alone exceeded Sarah's total annual investment contributions, even though both portfolios had similar total returns. The foundation of successful dividend investing lies in understanding what makes a dividend sustainable. Companies must generate sufficient cash flow to cover their dividend payments while maintaining adequate funds for business operations and growth investments. The dividend coverage ratio reveals this relationship by comparing a company's earnings per share to its dividend per share. A coverage ratio of 2.0 means the company earns twice what it pays in dividends, providing a substantial safety margin. Johnson & Johnson exemplifies dividend sustainability with its 60-year track record of consecutive annual dividend increases. The healthcare giant generates predictable cash flows from essential products that people need regardless of economic conditions. Their diversified revenue streams across pharmaceuticals, medical devices, and consumer products create stability that supports consistent dividend growth. Even during the 2020 pandemic, Johnson & Johnson maintained its dividend increase schedule because its business model generates reliable cash flows. What questions should you ask when evaluating a company's dividend sustainability during uncertain economic times? Start by examining the business model itself. Companies in essential industries like utilities, consumer staples, and healthcare typically maintain more stable cash flows than those in cyclical sectors like manufacturing or retail. However, even within stable industries, individual company execution matters significantly. The payout ratio provides another critical measurement by showing what percentage of earnings a company distributes as dividends. Companies paying out 30 to 60% of their earnings typically maintain sustainable dividend policies while retaining sufficient capital for reinvestment. Payout ratios above 80% often signal potential trouble, as companies lack flexibility to maintain payments during temporary earnings declines. Coca-Cola demonstrates how established companies can maintain dividend growth even during challenging periods. Despite facing declining soda consumption trends in developed markets, the company has increased its dividend for 60 consecutive years. Their global diversification, strong brand portfolio, and disciplined capital allocation enable consistent cash generation that supports reliable dividend growth. The company's management has explicitly committed to maintaining this dividend growth tradition, viewing it as a key component of shareholder value creation. Free cash flow analysis provides the most accurate picture of dividend sustainability because it measures actual cash generation rather than accounting earnings. Companies might report profits while struggling to generate cash due to working capital requirements or necessary capital expenditures. Sustainable dividend payers typically generate free cash flow that exceeds their dividend payments by comfortable margins. Microsoft transformed from a growth company to a dividend champion through disciplined capital allocation. When the company matured and could no longer reinvest all its cash flow at high returns, management began returning excess cash to shareholders through dividends and share buybacks. Their enormous cash generation from recurring software subscriptions provides predictable funding for consistent dividend growth. This transformation illustrates how even technology companies can become reliable dividend payers when their business models mature. Dividend yield often attracts investors initially, but focusing primarily on yield can lead to significant mistakes. High-yielding stocks frequently signal underlying business problems rather than attractive opportunities. Companies experiencing financial distress often see their stock prices fall faster than they can reduce their dividends, creating artificially high yields that prove unsustainable. The telecom sector during the early 2000s provides a cautionary example of yield traps. Many investors chased double-digit dividend yields from companies like WorldCom and other telecom giants without examining the underlying business fundamentals. When these companies' business models proved unsustainable, they not only cut their dividends but filed for bankruptcy, causing total losses for investors who focused on yield rather than business quality. How do you balance current income needs with long-term growth potential when building a dividend-focused portfolio? The answer lies in understanding your investment timeline and income requirements. Retirees might emphasize higher-yielding established dividend payers, while younger investors can focus on companies with lower current yields but stronger dividend growth prospects. Dividend growth investing offers a compelling middle ground by targeting companies that increase their dividends consistently over time. These companies typically start with modest yields, but provide growing income streams that can outpace inflation. A stock yielding 2.5% initially, but growing its dividend at 8% annually, will yield 5.4% on your original investment after 10 years. Realty Income Corporation, known as the Monthly Dividend Company, demonstrates how specialized business models can support exceptional dividend consistency. As a real estate investment trust focused on single-tenant commercial properties with long-term leases, the company generates predictable rental income that supports monthly dividend payments. Their 27-year track record of consecutive annual dividend increases reflects the stability of their underlying business model. Tax considerations significantly impact dividend investing returns, particularly for investors in higher tax brackets. Qualified dividends receive preferential tax treatment, taxed at capital gains rates rather than ordinary income rates. However, Investors should prioritize business quality and dividend sustainability over tax considerations when making investment decisions. Portfolio construction for dividend investing requires balancing several competing objectives: current income, dividend growth potential, sector diversification, and overall risk management. Concentrating too heavily in traditional dividend-paying sectors like utilities and consumer staples can create sector risk, while including too many high-growth, low-yield companies might not provide sufficient current income. The key to successful dividend investing lies in building a diversified portfolio of high-quality companies with sustainable competitive advantages, conservative payout ratios, and management teams committed to consistent dividend growth. This approach provides growing income streams that can support your financial goals while potentially appreciating in value over time, creating true wealth-building momentum that compounds through both dividends and capital appreciation. Part 3. Rebalancing rhythms. When to buy and sell investment portfolios require active management to maintain their intended balance and performance over time. Just as a well-tuned machine needs regular maintenance, your investment portfolio needs systematic attention to keep working effectively. Market movements naturally push your carefully constructed allocations off course, creating opportunities and risks that demand disciplined response. This section provides practical frameworks for managing your portfolio through time, establishing clear rules for when to buy and sell, and maintaining emotional discipline when markets test your resolve. Portfolio drift occurs naturally as different investments perform at varying rates. Consider Sarah, who built a portfolio with 60% stocks and 40% bonds. After a strong stock market year, her allocation shifted to 70% stocks and 30% bonds without her making any trades. This drift exposes her to more risk than originally planned and requires action. The question becomes when to act. Two primary approaches govern rebalancing decisions: time-based and threshold-based methods. Time-based rebalancing follows a calendar, reviewing and adjusting portfolios quarterly, semi-annually, or annually, regardless of market conditions. This approach provides simplicity and removes emotional decision-making from the process. Threshold-based rebalancing triggers action when allocations drift beyond predetermined limits. If Sarah sets a 5% threshold, she would rebalance when her stock allocation reaches 65 or 55%, bringing it back to her target 60%. This method responds to actual portfolio changes rather than arbitrary dates. Which approach serves investors better? Research suggests threshold-based rebalancing often provides superior risk-adjusted returns because it responds to actual portfolio needs rather than calendar dates. However, time-based rebalancing offers emotional benefits by creating routine discipline that many investors find easier to follow. The specific thresholds you choose matter significantly. Setting thresholds too narrow leads to excessive trading and higher costs. Setting them too wide allows dangerous drift that can undermine your investment strategy. Most successful investors use thresholds between 5% and 10% for major asset classes, with tighter ranges for more concentrated positions. Transaction costs represent a critical consideration in rebalancing decisions. Every trade involves costs that reduce your returns, including brokerage fees, bid-ask spreads, and potential tax consequences. Before rebalancing, calculate whether the benefits of returning to target allocations exceed these costs. Tax-efficient rebalancing strategies can significantly improve after-tax returns. In taxable accounts, avoid selling appreciated positions when possible. Instead, direct new investments toward underweight asset classes. Use tax loss harvesting opportunities to sell losing positions while purchasing similar investments to maintain desired exposure. Consider Michael, whose technology stocks appreciated dramatically, pushing his sector allocation from 15% to 25% of his portfolio. Rather than selling appreciated shares and triggering taxes, he could halt new technology purchases and direct fresh capital toward underweight sectors until his allocation returns to target. What emotional challenges make rebalancing difficult for most investors? The primary difficulty lies in selling winners and buying losers. When growth stocks soar, selling them feels like missing future gains. When value stocks languish, buying more feels like throwing good money after bad. This emotional challenge explains why systematic approaches prove essential. Successful rebalancing requires clear rules established when emotions run neutral. Write down your rebalancing criteria and stick to them regardless of market conditions or current performance. This discipline separates successful long-term investors from those who chase performance and react emotionally to market movements. Position sizing deserves special attention during portfolio maintenance. As individual positions grow or shrink, they may require specific attention beyond normal rebalancing. A single stock that grows to represent 10% or more of your portfolio creates concentration risk that threatens diversification benefits. Systematic position management involves setting maximum position sizes and reducing holdings that exceed these limits. Conservative investors might cap individual positions at 5% of their portfolio, while more aggressive investors might allow 8 to 10%. The key lies in establishing and maintaining these limits consistently. New position entry requires equally systematic approaches. Rather than adding positions based on tips or market excitement, establish criteria for new investments. These might include valuation metrics, business quality measures, or portfolio fit considerations. Document your investment thesis for each position to guide future hold or sell decisions. Complete position exits demand the most emotional discipline. Selling entire positions often feels like admitting mistakes or giving up on potential recovery. However, systematic exit criteria protect your portfolio from significant losses and free capital for better opportunities. Exit triggers might include fundamental deterioration in business prospects, valuation reaching extremely high levels, or better opportunities requiring capital redeployment. Whatever criteria you choose, apply them consistently without emotional interference. Portfolio rebalancing works best when integrated with broader financial planning. Coordinate rebalancing with regular contributions to retirement accounts, tax planning activities, and major life changes. This integration maximizes efficiency and minimizes unnecessary trading. Regular portfolio reviews should examine not just allocations, but also individual position performance and business fundamentals. Has the investment thesis for each holding remained intact? Have business conditions changed significantly? Are there better opportunities available? The most successful investors treat rebalancing as routine maintenance rather than dramatic portfolio overhauls. Small, regular adjustments maintain portfolio balance more effectively than large, infrequent changes. This approach also reduces the emotional impact of rebalancing decisions. Technology tools can assist with rebalancing by tracking allocations and highlighting drift automatically. However, avoid over-relying on automated systems that might trigger unnecessary trades or ignore important tax considerations. Use technology as a tool while maintaining human oversight and decision-making. Building rebalancing discipline takes time and practice. Start with simple approaches and gradually refine your methods based on experience and changing circumstances. The goal involves creating sustainable habits that serve your long-term investment success rather than perfect optimization of every decision. Remember that rebalancing serves risk management rather than return maximization. While proper rebalancing can enhance returns, its primary purpose involves maintaining your intended risk profile and preventing dangerous portfolio drift that could jeopardize your financial goals. Part 4. Tax-smart strategies, keeping more of what you earn. Smart tax planning transforms good investment returns into great after-tax wealth. While many investors focus solely on pre-tax performance, the money you keep after taxes determines your actual financial progress. This section reveals proven strategies for minimizing tax drag, optimizing account structures, and building wealth more efficiently. You will discover practical techniques for managing capital gains, harvesting losses strategically, and positioning assets to maximize after-tax returns while maintaining sound investment principles. Consider Sarah, a software engineer who earned 12% annual returns on her portfolio but paid substantial taxes each year on dividends and capital gains. After implementing tax-smart strategies, her after-tax returns improved to 10.8% annually. Over 20 years, this seemingly small improvement created an additional $150,000 in wealth compared to her previous approach. The foundation of tax-efficient investing begins with understanding how different accounts work together. Tax-advantaged accounts like 401ks and IRAs provide immediate benefits, but come with specific rules and limitations. Traditional retirement accounts offer current tax deductions, but require future tax payments on withdrawals. Roth accounts require upfront tax payments, but provide tax-free growth and withdrawals in retirement. Asset location strategy involves placing investments in the most tax-efficient accounts based on their characteristics. High-growth stocks belong in Roth accounts where unlimited appreciation faces no future taxes. Dividend-paying stocks and bonds work well in traditional retirement accounts where income generation avoids current taxation. Tax-efficient index funds and individual stocks held for long periods suit taxable accounts where favorable capital gains rates apply. A practical approach involves filling retirement accounts first with investments generating the highest expected returns or producing significant taxable income. Real estate investment trusts, high-yield bonds, and actively managed funds that generate frequent taxable distributions benefit most from tax-sheltered accounts. Growth stocks and tax-efficient index funds can effectively compound in taxable accounts while maintaining flexibility for strategic tax management. Tax loss harvesting represents one of the most powerful tools for reducing tax burden in taxable accounts. This strategy involves selling investments at a loss to offset capital gains from other investments. The key involves maintaining your intended portfolio allocation while capturing tax benefits. For example, selling a losing technology stock and immediately purchasing a different technology stock maintains sector exposure while creating a deductible loss. The wash sale rule prevents investors from claiming losses on securities repurchased within 30 days of sale. Smart investors work around this limitation by purchasing similar but not identical investments. Instead of repurchasing the same mutual fund, you might buy a different fund tracking the same index or invest in individual stocks within the same sector. How often do you review your portfolio for tax loss harvesting opportunities? And what systematic approach could you implement to capture these benefits consistently? Capital gains management requires strategic thinking about timing and tax brackets. Long-term capital gains face lower tax rates than short-term gains, making the one-year holding period crucial for tax efficiency. However, tax considerations should never override sound investment decisions. Holding a deteriorating investment solely for tax purposes often costs more than the tax savings provide. Advanced strategies include managing capital gains across multiple years to avoid pushing income into higher tax brackets. If facing a large gain from one investment, consider spreading the sale across 2 tax years or harvesting losses to offset the impact. High-income investors might time gains to coincide with years of lower income or higher deductions. Estate planning considerations become critical as wealth accumulates. Gifting appreciated securities to family members in lower tax brackets can reduce overall family tax burden. Charitable giving strategies using appreciated securities provide tax deductions while avoiding capital gains taxes. These approaches require careful coordination with overall financial planning, but can significantly enhance wealth transfer efficiency. Tax-efficient fund selection focuses on investments that minimize taxable distributions. Index funds typically generate fewer taxable events than actively managed funds due to lower turnover. Tax-managed funds specifically aim to minimize tax impact through careful security selection and timing of sales. Exchange-traded funds often provide better tax efficiency than mutual funds due to their structure and creation process. Consider Mark, a successful business owner who concentrated his taxable investments in low-turnover index funds while maximizing contributions to retirement accounts. He systematically harvested losses during market downturns and gifted appreciated shares to his children for college expenses. These strategies reduced his annual tax burden by $8,000 while maintaining his target asset allocation and investment returns. The biggest mistake involves letting tax considerations drive investment decisions rather than supporting them. Refusing to sell an overvalued stock solely for tax reasons, choosing inferior investments for minor tax benefits, or avoiding necessary portfolio rebalancing for tax concerns often reduces long-term wealth more than taxes themselves. What specific tax planning opportunities exist in your current portfolio? And how might you implement these strategies without compromising your investment objectives? Retirement account withdrawal strategies require careful sequencing to minimize lifetime tax burden. The traditional approach suggests withdrawing from taxable accounts first, then tax-deferred accounts, and finally tax-free Roth accounts. However, optimal strategies often involve strategic Roth conversions during lower income years and managing required minimum distributions to avoid higher tax brackets. Building tax awareness into your investment process creates compound benefits over time. Regular portfolio reviews should include tax planning considerations alongside investment performance. Systematic approaches to loss harvesting, gain management, and account optimization can add meaningful value without requiring complex strategies or frequent trading. The goal involves maximizing after-tax wealth rather than minimizing taxes at all costs. Sound investment principles remain paramount while tax efficiency enhances results. This balance requires ongoing attention and periodic strategy adjustments as tax laws, income levels, and portfolio values change over time. Chapter 6: The Disciplined Investor. Part 1: Emotional Mastery: Conquering Fear and Greed. The human mind becomes an investor's greatest asset or most dangerous enemy during volatile market periods. This section reveals how successful investors master their emotions through proven psychological frameworks and practical techniques. You will discover systematic approaches to recognize and overcome destructive biases, develop emotional resilience during market stress, and maintain rational decision-making when fear and greed dominate market sentiment. These skills separate truly successful investors from those who consistently underperform despite having access to the same information and opportunities. Sarah watched her retirement portfolio lose 30% of its value during March 2020. Every morning brought fresh losses as markets plummeted. Her first instinct was to sell everything and wait for stability. Instead, she followed a framework she had developed years earlier for exactly this situation. She took 3 deep breaths, opened her investment journal, and wrote down her emotional state before making any decisions. This simple practice saved her from a costly mistake that millions of other investors made during the same period. Fear and greed drive most poor investment decisions. Fear appears when markets decline and pushes investors to sell at the worst possible times. Greed emerges during bull markets and encourages reckless behavior and inflated expectations. Both emotions cloud rational judgment and lead to buying high and selling low, the opposite of successful investing. Consider how these emotions manifested during the dot-com bubble of 1999 to 2000. Greed convinced investors that traditional valuation metrics no longer mattered. Companies with no profits commanded billion-dollar valuations because investors feared missing out on easy profits. When reality returned, fear took over. Investors sold quality companies at bargain prices alongside worthless speculation. Recognition represents the first step toward emotional mastery. Successful investors develop awareness of their emotional states and triggers. They notice when their heart rate increases while checking portfolio values, or when they feel compelled to make immediate decisions based on news headlines. Creating space between emotion and action becomes critical. When strong emotions arise, effective investors pause before acting. They might count to 10, take a walk, or wait 24 hours before making significant decisions. This pause allows rational thinking to return and prevents emotional mistakes. What specific situations trigger your strongest emotional responses when investing? Understanding your personal patterns helps you prepare better responses. Cognitive biases represent systematic errors in thinking that affect everyone. Confirmation bias leads investors to seek information that supports their existing beliefs while ignoring contradictory evidence. An investor who believes a stock will rise might focus only on positive news while dismissing warning signs. Anchoring bias causes investors to rely too heavily on the first piece of information they receive. If someone first learns about a stock when it trades at $50, they might consider $40 cheap, even if the company's fundamentals have deteriorated significantly. Loss aversion makes people feel losses more intensely than equivalent gains. This bias causes investors to hold losing positions too long, hoping to break even while selling winners too quickly to secure small profits. Systematic approaches help counteract these biases. Before researching any investment, write down what you expect to find. This practice helps identify confirmation bias when you only discover supporting evidence. Always seek opposing viewpoints and assign someone to play devil's advocate with your ideas. Create checklists that force consideration of multiple perspectives. Include questions like, what could go wrong with this investment? And why might someone disagree with my analysis? These prompts help overcome natural bias toward overly optimistic thinking. David, a successful fund manager, maintains what he calls a bias journal. After every investment decision, he records which biases might have influenced his thinking. Over time, he identified his tendency toward overconfidence in technology stocks and anchoring bias when analyzing companies he knew well. This awareness improved his decision-making process significantly. Market stress tests emotional discipline like nothing else. During the 2008 financial crisis, many investors abandoned sound strategies they had followed for years. The key lies in preparing for these periods before they arrive. Develop written investment policies during calm periods. Document your investment philosophy, risk tolerance, and decision-making criteria. When emotions run high, refer to these guidelines instead of making reactive decisions. Having predetermined rules removes emotion from the equation. Regular meditation practice builds emotional resilience over time. Even 10 minutes daily helps develop awareness of thoughts and emotions without being controlled by them. Many successful investors credit meditation with improving their ability to think clearly under pressure. Journaling provides another powerful tool for emotional management. Write about your feelings regarding market conditions and investment performance. This practice helps process emotions constructively, rather than letting them build up and influence decisions. Physical exercise reduces stress and improves mental clarity. Many investors find that regular workouts help them maintain perspective during difficult market periods. The discipline required for consistent exercise also transfers to investment discipline. How do you currently handle stressful situations in other areas of your life? These same techniques often work well for investment stress. Independent thinking becomes essential when market sentiment conflicts with your analysis. Markets regularly overreact in both directions, creating opportunities for investors who can think differently from the crowd. Warren Buffett demonstrated this principle when he invested heavily in financial stocks during 2008, while most investors fled the sector. His independent analysis suggested that quality banks trading at deep discounts represented excellent long-term opportunities despite widespread fear. Developing contrarian instincts requires practice and confidence in your research process. Start by questioning popular investment themes. When everyone loves a particular sector or strategy, examine why it might be overvalued. When everyone hates something, consider whether the pessimism has created bargains. Create a systematic process for evaluating your analysis against market sentiment. If your research suggests a stock is undervalued but the market disagrees, double-check your work rather than immediately changing your opinion. Markets can remain irrational longer than you expect, but quality analysis eventually proves correct. Building conviction in your research requires thorough preparation and honest self-assessment. The more work you put into understanding an investment, the easier it becomes to maintain confidence when others disagree. Regular practice with smaller amounts helps build confidence for larger decisions. Start by making contrarian investments with money you can afford to lose completely. As your skills improve and results validate your approach, gradually increase position sizes. Track your emotional responses and decision-making patterns over time. Notice which situations challenge you most and develop specific strategies for those scenarios. This ongoing process of self-improvement separates successful long-term investors from those who struggle with emotional decision-making throughout their careers. Part 2. Market Cycles. Riding the Waves of Change. Market cycles move in predictable patterns that smart investors can recognize and use to their advantage. While no one can perfectly predict when markets will rise or fall, understanding these patterns helps investors make better decisions about when to buy, sell, and hold. This knowledge transforms market volatility from a source of stress into opportunities for building wealth. By learning to identify different phases of economic and market cycles, investors can position their portfolios to benefit from inevitable changes while avoiding the common trap of trying to time markets perfectly. Markets behave like ocean tides, moving in repeated cycles that follow recognizable patterns. During bull markets, prices rise steadily as optimism spreads and more people invest. Eventually, prices climb too high compared to underlying company values, creating dangerous bubbles. When these bubbles burst, bear markets follow with falling prices and widespread pessimism. Finally, markets reach extremely low levels where bargains become available, setting the stage for the next cycle to begin. Consider the technology bubble of the late 1990s. Stock prices soared as investors believed internet companies would revolutionize business forever. Companies with no profits traded at astronomical valuations. Smart investors like Warren Buffett avoided these overpriced stocks and faced criticism for being outdated. When the bubble burst in 2000, technology stocks fell 70 to 80% from their peaks. Investors who recognized the bubble sold early or avoided the sector entirely, while those caught up in the excitement suffered massive losses. The housing crisis of 2008 followed a similar pattern. Real estate prices climbed far beyond historical norms as banks made risky loans and investors assumed prices would keep rising forever. When the bubble burst, home values plummeted and triggered a global financial crisis. Investors who recognized the signs early moved money to safety, while others lost fortunes. What warning signs might you be overlooking in today's markets that could signal the next major cycle change? Economic cycles create the backdrop for market movements. During expansion periods, companies grow revenues and profits as consumers spend more money. Employment rises and confidence increases, supporting higher stock prices. Eventually, growth slows as the economy reaches capacity limits and inflation pressures build. Central banks typically raise interest rates to cool down overheating, which can trigger recessions. Recessions bring falling profits, rising unemployment, and widespread fear. Stock prices often decline 20 to 50% during these periods as investors sell everything to preserve capital. However, recessions also create exceptional buying opportunities for patient investors with available cash. Companies with strong balance sheets and competitive advantages often trade at bargain prices during these periods. The 2020 pandemic created a unique cycle disruption. Markets crashed 35% in just weeks as lockdowns shut down the global economy. Yet massive government stimulus and Federal Reserve intervention created one of the fastest recoveries in history. Investors who bought quality stocks during the March 2020 panic earned exceptional returns as markets rebounded to new highs within months. Smart investors adjust their strategies based on cycle phases without abandoning core principles. During late-stage bull markets, when valuations become stretched, they gradually reduce stock positions and build cash reserves. This approach preserves gains and creates ammunition for the next downturn. When bear markets arrive, they systematically invest their cash reserves in quality companies at discounted prices. The key lies in maintaining discipline during emotional extremes. When everyone else panics during crashes, intelligent investors stay calm and look for bargains. When euphoria grips markets during bubbles, they resist the urge to chase overpriced stocks and instead prepare for inevitable corrections. HTML. John Templeton demonstrated this approach masterfully during World War II. In 1939, as war fears gripped markets, he bought every stock trading below $1 per share on major exchanges. Most investors avoided these worthless companies, but Templeton recognized that extreme pessimism had created exceptional values. 4 years later, he sold his positions for massive profits as the economy recovered and optimism returned. How might your current investment strategy change if you knew a major market downturn was coming within the next 2 years? Successful cycle investing requires specific techniques that prevent common mistakes. First, avoid trying to time exact market tops and bottoms. Even professional investors cannot consistently predict precise turning points. Instead, focus on gradual adjustments as cycles progress. Begin reducing positions when valuations become clearly excessive, and start increasing investments when prices fall significantly below fair value. Second, maintain adequate cash reserves during good times to take advantage of future downturns. Many investors stay fully invested during bull markets and have no money available when bargains appear. A disciplined approach involves gradually building cash positions as markets rise and valuations stretch. Third, focus on individual company fundamentals rather than broad market predictions. Even during bear markets, some companies continue growing and creating value. Conversely, during bull markets, some companies face serious problems despite rising stock prices. Quality analysis remains crucial regardless of cycle phase. Fourth, diversify across different asset classes and geographic regions. Economic cycles affect various investments differently. When stocks struggle, bonds might perform well. When domestic markets falter, international opportunities may emerge. Diversification provides stability during turbulent periods. The relationship between cycles and valuations creates the foundation for intelligent investing. During expansion phases, rising earnings often justify higher stock prices initially. However, as cycles mature, prices typically rise faster than earnings, creating expensive valuations. Smart investors recognize when price increases outpace fundamental improvements and begin reducing positions. Bear markets reverse this relationship. Stock prices often fall faster than earnings decline, creating attractive valuations for patient investors. Companies with strong competitive positions and solid balance sheets become available at prices that would have seemed impossible during previous bull markets. Consider how different your investment returns might be if you successfully bought more shares during the 3 worst market years of the past decade and sold some during the 3 best years. This simple cycle-aware approach could dramatically improve long-term results without requiring perfect market timing. The emotional challenge of cycle investing cannot be overstated. Buying when others are selling requires tremendous courage and conviction. Selling when others are buying demands discipline to forego short-term gains for long-term protection. Developing these psychological skills takes practice and systematic approaches that override natural emotional responses to market extremes. Part 3. Common pitfalls. Mistakes that cost money. Investment mistakes destroy more wealth than market crashes, economic recessions, or external events combined. While investors spend countless hours analyzing companies and market trends, they often overlook the behavioral traps and systematic errors that sabotage their best intentions. The most dangerous mistakes are not random accidents, but predictable patterns that repeat across generations of investors. Understanding these patterns and building defenses against them can mean the difference between financial success and devastating losses. This knowledge transforms how you approach every investment decision, creating systems that protect your capital while others fall victim to costly but preventable errors. The overconfidence trap catches even seasoned professionals off guard. After experiencing a few successful investments, many investors begin to believe their success stems from superior skill rather than favorable market conditions or simple luck. This psychological shift leads to taking larger risks, conducting less thorough research, and ignoring warning signs that would have prompted caution during earlier, more humble periods. Consider the case of a technology executive who made substantial profits during the late 1990s internet boom. His early investments in established companies like Microsoft and Intel generated impressive returns, convincing him he possessed special insight into technology stocks. This confidence led him to invest larger amounts in increasingly speculative companies. When the market crashed in 2000, his portfolio lost over 80% of its value because he had concentrated his holdings in high-risk technology stocks and ignored basic valuation principles. The diversification fallacy represents another costly mistake that appears deceptively simple to avoid. Many investors believe they are diversified when they own stocks in different companies, but true diversification requires understanding correlation between investments. Owning 10 different bank stocks does not provide meaningful diversification because all banks face similar risks from interest rate changes, regulatory shifts, and economic downturns. During the 2008 financial crisis, investors who thought they were diversified by owning stocks in various financial companies discovered their mistake when all their holdings declined simultaneously. Real diversification means spreading investments across different industries, geographic regions, company sizes, and asset classes that respond differently to economic events. How often do you review whether your investments truly move independently of each other during stressful market periods? Following crowd behavior creates some of the most expensive investment mistakes. When everyone seems to be making money in a particular sector or strategy, the temptation to join becomes overwhelming. This herd mentality typically reaches its peak just before major market corrections, ensuring that late arrivals pay the highest prices for assets about to decline in value. The housing bubble of the mid-2000s perfectly illustrates this pattern. As home prices rose consistently for several years, more investors entered the real estate market through direct purchases, real estate investment trusts, and housing-related stocks. The widespread belief that housing prices never decline nationally created false confidence. Investors who joined this trend in 2005 and 2006 experienced devastating losses when the bubble burst, while those who recognized the crowd behavior and stayed away preserved their capital. Analytical errors compound these behavioral mistakes by providing false justification for poor decisions. Many investors rely on oversimplified metrics or fail to understand the limitations of their analysis. Price-to-earnings ratios can mislead when earnings are temporarily inflated or when comparing companies with different growth rates. Similarly, focusing solely on past performance ignores changing business conditions that might make historical results irrelevant for future prospects. A common analytical error involves extrapolating short-term trends indefinitely into the future. During the commodity boom of the early 2000s, many investors assumed that rising demand from developing countries would continue driving prices higher for decades. They failed to consider that high prices would eventually stimulate increased supply and encourage conservation, leading to price corrections that caught trend followers unprepared. Process failures often prove more costly than individual bad decisions because they create systematic weaknesses that generate repeated mistakes. Successful investing requires consistent procedures for research, decision-making, and portfolio management. Without these systems, even knowledgeable investors make preventable errors during stressful periods. Creating effective checklists prevents many process failures. Before making any investment, experienced investors systematically review factors such as company financial health, industry competitive position, valuation relative to historical norms, and how the investment fits within their overall portfolio strategy. This disciplined approach helps maintain objectivity when emotions run high. What systematic processes do you currently use to ensure consistent decision-making across all your investments? Learning from mistakes requires honest self-assessment and detailed record-keeping. Many investors remember their successes vividly while quickly forgetting or rationalizing their failures. This selective memory prevents the learning necessary for improvement. Maintaining detailed investment journals that record not just what you bought and sold, but why you made each decision, creates valuable material for future analysis. Regular portfolio reviews should examine both successful and unsuccessful investments to identify patterns in decision-making. Sometimes investments succeed for reasons different from your original thesis, which suggests gaps in your analysis process. Similarly, understanding why certain investments failed helps prevent similar mistakes in the future. The most effective approach to mistake prevention combines systematic procedures with continuous education. Markets evolve constantly, creating new types of opportunities and risks. Investors who stop learning and rely solely on past experience often find their methods become outdated and ineffective. Staying current with market developments, new analytical techniques, and evolving business models helps maintain the flexibility needed for long-term success. Building mistake prevention systems requires acknowledging that errors are inevitable parts of the investment process. The goal is not perfect decision-making, but rather creating frameworks that minimize the frequency and severity of mistakes while maximizing learning from each error. This approach transforms mistakes from wealth destroyers into valuable education that improves future investment results. Part 4. Your Investment Action Plan, From Theory to Practice. Converting investment wisdom into practical action separates successful investors from perpetual students. This section bridges the gap between theoretical knowledge and real-world implementation, providing concrete frameworks for establishing your investment practice. You will learn systematic approaches to building portfolios, selecting tools, and maintaining discipline throughout your investment journey. The focus remains on creating sustainable processes that grow with your experience and capital, ensuring long-term success through methodical execution rather than sporadic market participation. The journey from investment theory to practice begins with establishing clear personal guidelines. Sarah, a marketing manager, spent months reading investment books but never bought her first stock because she felt overwhelmed by choices. Her breakthrough came when she wrote down 3 simple rules: only invest money she would not need for 5 years, never put more than 5% of her portfolio in any single stock, and always research a company for at least 2 weeks before investing. These basic guidelines gave her the confidence to start investing and provided boundaries that prevented emotional decisions during market volatility. Your investment policy statement serves as the foundation for all future decisions. This document should outline your investment goals, risk tolerance, time horizon, and specific criteria for buying and selling securities. Consider including target allocation percentages for different asset types, maximum position sizes for individual investments, and circumstances that would trigger portfolio rebalancing. The policy statement acts as an anchor during turbulent markets, reminding you of your original reasoning when emotions run high. Starting with limited capital requires different strategies than managing substantial wealth, but the fundamental principles remain consistent. Many successful investors began with small amounts, reinvesting profits and adding regular contributions to build meaningful portfolios over time. Mark, a teacher earning $45,000 annually, started with $500 and committed to investing $200 monthly. Within 7 years, his disciplined approach and compound growth created a portfolio worth over $25,000, demonstrating how consistency matters more than initial capital size. When selecting a broker, prioritize low costs, reliable execution, and adequate research tools over flashy features or complex trading platforms. Commission-free stock trading has become standard, but examine other fees, including account maintenance charges, transfer fees, and costs for additional services. The platform should provide easy access to company financial statements, analyst reports, and basic screening tools for finding investment candidates. Account setup involves more than simply opening a brokerage account. Consider the tax implications of different account types, including traditional and Roth retirement accounts, taxable investment accounts, and health savings accounts that can serve dual purposes. Each account type offers different advantages depending on your income level, time horizon, and investment goals. How might your current tax situation and future expectations influence your choice of account types? Portfolio construction requires balancing diversification with concentration based on your research capabilities and risk tolerance. Beginning investors should start with broader diversification, perhaps holding 15 to 20 stocks across different industries and adding individual positions gradually as knowledge and confidence grow. More experienced investors might concentrate holdings in their best ideas while maintaining adequate diversification to manage risk. Establishing monitoring systems prevents both neglect and obsessive tracking of your investments. Quarterly reviews typically provide sufficient frequency for most long-term investors, allowing enough time for business fundamentals to develop while preventing excessive trading based on short-term price movements. Create a simple spreadsheet or use portfolio tracking software to monitor key metrics, including total return, individual position performance, and portfolio allocation compared to your target weights. Regular portfolio maintenance involves rebalancing when allocations drift significantly from targets, adding new positions when attractive opportunities arise, and selling when your investment thesis no longer holds or better alternatives emerge. Avoid making changes based solely on recent performance, whether positive or negative. Instead, focus on whether the underlying business fundamentals support your original investment reasoning. Continuous education remains essential as markets evolve and your experience grows. Schedule regular time for reading annual reports, industry publications, and investment literature. Follow several companies closely, even if you do not own their stocks, developing skills in financial analysis and business evaluation through practice. Consider joining investment clubs or online communities where you can discuss ideas with other serious investors. Performance tracking should emphasize learning over simple return calculations. Document your investment decisions, including the reasoning behind each purchase and sale. Review these records periodically to identify patterns in your successful and unsuccessful investments. This analysis helps refine your investment process and avoid repeating mistakes. Building systems for idea generation ensures a steady pipeline of potential investments. Develop screens for identifying companies that meet your criteria, follow industry publications for emerging trends, and monitor insider buying activity for potential opportunities. Maintain a watch list of interesting companies that do not currently meet your purchase criteria but might become attractive during market downturns. Scaling your investment approach as wealth grows might involve adding asset classes, increasing position sizes in your best ideas, or exploring more complex strategies. However, maintain the core principles that created your initial success, rather than abandoning proven methods for more sophisticated approaches that might not suit your skills or temperament. What specific steps will you take this week to begin implementing your investment plan, and how will you measure progress toward your long-term goals? The transition from theory to practice requires action, discipline, and patience, but following systematic approaches creates the foundation for long-term investment success.